Welcome back to Trading for Life. In this part of our audiobook, Stan Weinstein's Secrets for Profiting in Bull and Bear Markets, we move into the most critical phase of market mastery, knowing when to exit, how to profit in down markets, and how to align yourself with the market's true direction. We'll begin with Chapter 6, When to Sell, where Weinstein explains why selling is often more important than buying, how to protect profits, and how to recognize the early warning signs that a trend is ending. Next, in Chapter 7, Selling Short, the Less Traveled Road to Profits, we explore how professional traders make money during bear markets, the psychology behind short selling, and the technical conditions that stack the odds in your favor. In Chapter 8, Using the Best Long-Term Indicators to Spot Bull and Bear Markets, Weinstein reveals the big-picture tools that separate noise from real trend changes, helping you stay on the right side of the market cycle. Chapter 9, Odds, Ends, and Profits, ties together practical insights, common mistakes, and refinements that can dramatically improve consistency over time. And finally, Chapter 10, Putting It All Together, brings the entire methodology into one complete trading framework, combining trend analysis, timing, risk management, and discipline into a clear, repeatable approach. This section is where strategy becomes execution, and knowledge turns into confidence. Let's continue.
Chapter 6, When to Sell. You are now more than halfway down the road to successful investing. To complete the journey, there is one more very important step to master: learning when to sell. The sell decision is crucial if you are going to really win big in the market. Unfortunately, few market players ever master this important step. Carrying just one Avon from 140 down to 19, or a floating point from 45 to 8.50, can put you out of action fast, with no chance of a comeback. See charts 6.1 and 6.2. It's hard to believe how many times I've seen portfolios filled with stocks that were once winners but are now disasters. You know the story. XYZ was bought properly at 40, and then it quickly ran up to 60. But the word was out that it would soon run to 100, so why sell? When it dropped to 20, you discovered only too well why it should have been sold. Alfin and VM Software, charts 6.3 and 6.4, illustrate clearly how important it is to learn how to sell properly. In both cases, buy signals were registered point A on the charts. In the following months, these stocks made advances that are the stuff of a buyer's dream. But if you had stayed married to them, that dream would have turned into a nightmare. After an exciting advance, each gave back its entire gain. Even worse, they actually turned into losses. Once you perfect the techniques of this very important chapter, you'll never again experience this gut-wrenching roller coaster action. Also damaging to portfolio results is the tendency to sell too soon. How often have you bought a stock just right, then seen it triple in 12 to 18 months, but without you still in it? Instead of riding it from 40 all the way up to 120, you took a fast profit at 50, wrongly believing that you can't go broke taking a profit. The truth is that in the long run, you need to capture these giant advances to offset the losses from occasional mistakes. By doing this, you'll have big net profits left over. The problem is that an investor or trader often sells for no other reason than his feeling that the stock is too high. He then watches it go much higher without him. Is there really a way to make an intelligent judgment that a particular stock has had it and is about to stagger? There most certainly is, and it centers around my method of stage analysis. Before getting into the proper techniques of selling, it's useful to analyze the incorrect approach followed by most investors. Don'ts for selling. 1. Don't base your selling decision on tax considerations. This is truly a case of letting the tail wag the dog. Too often an investor will decide that he can't sell a given stock because there is too big a tax bite. Then in the following months the stock plummets and wipes out a good portion of the profit. This decline, if avoided, could have paid for the taxes and still have left a good gain. Furthermore, you then could have moved into a new stage 2 situation that had the potential to rack up an additional gain. The following true story will show you exactly what I mean. Back in 1978, when I was speaking at an investment seminar, I said that after having been bullish on the casino stocks, I was now issuing a sell signal. After my speech, a distraught investor, we'll call him Jim, came over and said that he had a serious problem. He was holding several thousand shares of Resorts International Class, AC chart 6.5. The stock was around 65 at the time and the high was 70, so I figured at worst he had a 5-point loss. I therefore told him, don't be so upset, just take your small loss and you'll make it up in another issue. He then shocked me by saying, oh, I don't have a loss. I bought the stock around 20. My problem is that I have too big a profit and will have to pay too much in taxes. I told him that everyone should have such problems, and that I would sell the stock and simply consider the tax consequences as a cost of doing business. 1 year later, when I again addressed that same conference, I saw Jim again. When he came over to say hello, he reminded me about our talk the prior year. I asked how his problem had turned out. "Oh, I don't have a problem anymore," he said. "Resorts is now back down to 20, and I no longer have a gain to worry about." Don't ever fall into this trap. When a stock turns negative, it's a sale whether you have a profit or a loss or have to pay taxes. The bloodless verdict of the marketplace doesn't know what you paid for the stock and doesn't care. You have to learn to be objective and dispassionate. 2. Don't base your selling decision on how much the stock is yielding. Far too often, investors decide to hold onto a stock that is weakening because it pays a great dividend. This is silly because after the stock drops a few points, as in the case of Rochester Gas and Electric in 1987, Chart 6.6, the sell-off wipes out the whole year's worth of dividends plus more. This type of thinking is especially common when dealing with utility stocks, which typically offer a generous yield. It's great to hold onto these stocks while they are in stage 2. Even though they won't usually rocket ahead, they are good total return situations, price appreciation plus yield, that certainly beat the 5.50% yield of the bank. But once these stocks move into stage 4 and start heading south, it's ridiculous to hold onto them any more than you would hold any other stage 4 loser. Remember, if you get a 10% yield but lose 20% because of price depreciation, that's not winning mathematics, and that's the good news. It could be worse. There's always the distinct possibility that the plunge in stock price is a signal of future bad economic news for the firm. The news may be so negative that the company may not even have the ability to pay future dividends at all. Many investors in continental Illinois and other falling angels learned this lesson the hard way. 3. Don't hold onto a stock because the price and earnings P/E ratio is low. This ratio often appears to be at a bargain level even though your stock is topping out. The stock often declines and only months later reports disappointing earnings. By this time, the P/E ratio no longer appears low at all, but at that point, it is too late to sell profitably. In addition, there are many cases where the P/E ratio is low and stays low, and the stock gets bashed anyway. Chart 6.7 of Chase Manhattan illustrates exactly what I'm talking about. When CMB neared 50 in 1986, the P/E was a very low 7. Interestingly, 13 months later, the P/E was an even bigger bargain at 6. Unfortunately, the stock had moved into stage 4 and dropped from close to 50 down to 34. So much for low P/Es as a reason to hold on. 4. Don't sell a stock simply because the P/E is too high. The converse of the prior example is also a serious problem. There's an old Wall Street joke that has an investor ask his broker why a given stock went up. For lack of a better explanation, the broker quips, "More buyers than sellers." There's more truth than fiction to the message behind that joke, but few investors ever learn it. They always want rational answers why a stock moves. They are really getting either excuses or conjecture. Few market participants ever learn that the market isn't always rational. All it does is reflect the prevailing psychology or mood of investors. If investors become overly bullish and lapse into optimistic dreams, then high P/Es can go much higher. Tandem Computers Chart 6.8 illustrates this point clearly. P/E ratio of 32 was no bargain in late 1985 when TDM moved above resistance at 10.A. 15 months later, it was an even higher 44 as the stock price neared the 38 level. Investors are like manic depressives. When they become optimistic, they'll find excuses to buy stocks no matter how high the P/E gets. On the other hand, when they become bearish and worried, they will shy away from buying no matter how cheap the P/E appears. So the secret is to accept that too high can become much higher when a stock is in stage 2, and hold back on your selling until you see the whites of their eyes and stage 3 starts to form. This is far more important than too high a P/E, because it objectively shows that the very powerful buying which catapulted your stock higher is now finally meeting equally powerful selling. It is not the fuzzy concept of being overvalued that causes a stock to top out, but the measurable reality that supply finally equals demand. Chart 6.9 of Maxter says it all. When MXDR moved above 8 resistance in early 1986, the stock was a solid stage 2 buy even though the P/E was far from cheap at 16. And at point A, the P/E was a very high 28. Later at B, it was still a fundamentally dangerous 24. At point C, it was still on the high side at 20. Yet, since the EMA was still rising, our method of stage analysis argued strongly to ignore the P/E danger and hold. Months later, the stock zoomed up close to 34 and the P/E reached a very high 33 point D. Still later at point E, the P/E was a worrisome 28. If you had based your sell decision on this ratio, you would have sold at a price of 16 point A. But MXDR didn't flash a real sell signal until point F, when it broke down from an important top formation as the EMA leveled out. A few months later, the stock crashed to 9.625. Note that the P/E was on the high side for 18 months while the stock advanced. Only after supply moved into equilibrium with demand and a dangerous stage 3 top formed did Maxter finally decline. This clearly illustrates why our technical method is so much more helpful and precise than the subjective theory of P/E overvaluation. 5. Don't average down in a negative situation. Whether it's watching Polaroid chart 610 drop from close to 150 down to 16 in 1974, or seeing Western Health Plan's chart 611 drop from 15% in 1985 down to 3 2 years later, the details are always the same. These are stocks that had moved into stage 4 and should have been sold. Unfortunately, many investors fell into the fundamentals trap. First, they held on because it was a good company, or so they thought. When they realized they were in trouble, they determined to get out even on the next rally. This is market masochism at its worst. In so many stage 4 bombings, the stock never gives you the opportunity to come close to getting out even. Then panic takes over, and these ill-starred investors shoot themselves in the foot by averaging down. This technique is great in theory, but suicidal in practice. Those who practice this dangerous technique are courting financial disaster. Anacomp in 1983 to 1984, chart 612, and Halliburton in 1981 to 1982. Chart 613 are just 2 more examples out of several hundred that show how you could have been wiped out by employing this foolish tactic. Anacomp gave a clear sell signal when it broke below 18 on its downward trek to 2. Halliburton also flashed sell when it broke below the EMA and supported 70 on its way to 21. Don't ever fall into the seductive trap of thinking that by buying more at a lower price, the stock will only have to rally half as much before you get out even. Do as professionals do. Average up, not down. When market action starts to show them they are right, the pros pile on further, not when they've been proven wrong. Instead of sitting on a problem stock, they get out promptly. Learning how to handle a losing situation and keeping losses to a minimum is one of the most important secrets of successful investing. It is so important that I devote an entire section later in this chapter to this very important topic. The averager is thrown off the profitable track since he is buying more rather than getting out. Even if the stock rallies a bit, he runs into further trouble because he has a target price in mind where he'll get out even. When the advance fails to reach that price, he grimly continues to hold because of his mathematical goal. As you can see from these few examples, averaging down can be particularly crippling if you hold through a real stage 4 debacle. Every time you average in the hope of hitting the bottom, you simply add more shares and more losses to your portfolio. The result is that you throw good money after bad. Instead of being a conservative portfolio device, it's actually highly speculative. Trying to guess the bottom in a weak stock is like fishing in the ocean with your fingers. Hope is a foolish reason for holding on, and it's an even worse reason for buying more. So learn to lock in your profits using protective sell stops and cut your losses short by recognizing when your stock is running into trouble. If you follow this winning discipline, you'll still have the capital to make up your loss on future purchases. 6. Don't refuse to sell because the overall market trend is bullish. While it's true that a powerful bull market will often bail you out of some of your less brilliant judgments, don't think it's a panacea for every market problem. Sure, the major uptrend will usually add points to your stage 2 winners. It's also true that a raging bull market will often limit the downside on problem stocks. This is why there is an old Wall Street saying, "Don't confuse brains with a bull market." Nevertheless, if a stock really starts to flash technical danger, don't think twice. Get out. Just the fact that a stock is showing weakness in the face of a soaring market is a warning that disaster is getting ready to strike. McLean Industries, Chart 614, and Sunbelt Nursery, Chart 615, exemplify this point. While the Dow Jones Industrial Average rallied from 1250 to 2746, McLean dropped from 15 to 75 cents. In the same manner, Sunbelt sold off from 15.50 to 5.50, while the Dow raced ahead from 1500 to 2746. Holding these, as well as dozens of other stage 4 disasters, because the overall market was bullish, proved very costly. Don't ever fall into that trap. 7. Don't wait for the next rally to sell. When the chart pattern signals that a stock is running into trouble, get out immediately. Don't wait around trying to recoup an extra point or two on a rally. Chances are this tactic will cost you a lot of your market capital. The cases of River Oaks and Saving, Charts 616 and 617, demonstrate this situation. River Oaks should have been sold breaking below 6. It never rallied back to that level on the way down to a low of 25 cents. Saving gave a strong sell signal breaking below 7.25. It never rallied back to that level as it headed south with a vengeance, bottoming at 1.125. So once you spot the telltale signs of danger and realize that your stock is a sale, do just that, sell it, and don't worry about getting a fractionally better price. 8. Don't hold onto a stock simply because it is of high quality. So-called quality stocks have cycles too, and once they turn negative will cause you just as much financial heartache. IBM is considered to be the epitome of quality, but its chart 618 should convince you that quality is no shelter from severe loss. In early 1973, as the stock reached its peak above 360, the trailing 12-month earnings were $8.82 per share. 20 months later, the earnings were up to $12.24. Unfortunately, the stock price showed that the market didn't care. It had entered a stage 4 pattern that carried it down to 155. So much for quality. Central Hudson Gas and Electric, Chart 619, also teaches this important message. It turned negative in 1986, breaking below 35, and dropped close to 23 while one of the great bull markets in history unfolded. Every dog has its day in the market. When a low-quality stock moves into stage 2, that's its day, and it's a better buy at that point than a high-quality company that has entered stage 4. Selling properly, the investor's way. Now that we know what not to do, let's zero in on the correct way to determine when to sell. While the theory is similar for both investors and traders, there are different guidelines and parameters for each. First, let's deal with the investor's way. We'll examine how a trader should operate in the next section. The first thing any good trader or investor should do is realize that they must never hold any position without a protective sell stop. Any futures trader worth his salt knows that this is a crucial technique for success. The stock market isn't all that different. The moves are just slower. With the advent of stock index futures and program trading, the distinction is narrowing quickly. Cycles that used to take years to unfold in the 1950s and 60s are now occurring in a matter of months. This increased volatility in the stock market is a two-edged sword. On the positive side, it gives us a chance to make money even faster. The downside is that when a reversal occurs, your stock can move from stage 2 into stage 3 far more quickly. This is especially true if it's one of the overly loved institutional favorites. These issues can really change direction in a hurry when bad news comes out and the institutional herd starts to panic. The way to protect yourself is by using a sell stop order. It is the mirror image of the buy stop order that I taught you in Chapter 3. Sell stop orders. A sell stop order will be executed only if a predetermined level is hit. For example, if stock XYZ is currently trading at 30 and you put in a sell stop order at 26.875, it will go into effect only if XYZ breaks below 27. It then becomes a market order to sell. In most cases, the transaction will take place very close to 26.875. As with the buy stop order, you should enter it on a good till canceled GTC basis. One difference from our buy stop technique is that if the stock is on the New York Stock Exchange, I suggest that you place a straight sell stop rather than a sell stop limit order. On the NYSE, you can use either, but selling is far different from buying. When trying to purchase, we can be very choosy about how much we are willing to pay for a given stock. If it breaks out at 20.125 and we had placed a 20.125 stop, 20.375 limit order that isn't filled, so be it. But when selling, you already own the stock and it doesn't pay to fool around. If it turns negative, you want out. On the American Stock Exchange, you aren't allowed to use a straight stop order. They only accept stop limit orders, but the Amex has almost joined the 20th century. Previously, the stop limit had to be at one price, e.g. stop 26.875 limit 26.875. If the stock dropped quickly below your sell level without your receiving an execution, you were out of luck. Now, however, they allow the price to be spread out so you can say, for example, sell XYZ 26.875 stop 26 limit. Therefore, if you enter the order with a wide spread, there should be no problem. Again, be sure to enter it on a GTC basis. As for over-the-counter stocks, we must deal with the same problem we encountered on the buy side. No stop orders, either sell or buy, are allowed. You must work closely with your broker on these stocks and have him follow them on his monitor. If they break their danger levels, they should be sold immediately, at the market, which should pose no problem since this is all you are really asking of your stockbroker. From now on, you are going to make your own buy and sell decisions. All you want from your broker is service. Most will be happy to comply, especially since you are going to be a far more active account than the buy and hold clients. If you come across a broker who isn't cooperative, get a new broker. While on the subject of stockbrokers, I want to stress that you should make sure that you do not pay full commissions. It's obvious that you can save substantial commissions at a discount broker, and there are many excellent ones. But what is not so obvious and many investors don't realize is that you can get a substantial discount from most full-service brokers. It's simply a matter of asking, doing a bit of shopping around and negotiating. Again, since you are going to be a fairly active account, you should have no problem negotiating a healthy discount. Don't underestimate how important the savings will be to you over the years. Dealing with either a discount or full-service broker, or both, is fine as long as you get a good commission rate. The proper use of protective sell stops is going to be a central part of your selling strategy. It will keep your decision-making simple, objective, and unemotional. You also won't have to constantly rethink whether it's time to lock in your profit or cut short your loss. This simplification of the selling process is more important than ever with the market becoming increasingly volatile. You don't want to suddenly sell a perfectly fine Stage 2 stock simply because you see that the Dow has dropped 60 or 70 points that day, and your stock has dropped sharply because it's gotten caught in the crossfire of several sell programs. The overwhelming majority of market professionals use protective sell stops, but the public does not. The reason is simple. Very few market players truly understand how to properly use them. This incredibly profitable tool has gotten an undeserved bad reputation because many investors hear about them and then use them in the following ridiculous manner. They read about and embrace the notion that sell stops should be placed 10 to 12 or 15% below current prices to protect their positions. This is bad advice that leads to even worse results. There is no magic level that is the right percentage. You can't consistently make money in the market following such shallow thinking. How can 10% or any other given percentage be the right level? Does the market know or care what price you paid? Chart 620 shows what I mean. USX Corporation broke out at 22.375 point A in 1986. If you had arbitrarily protected it with a 10% sell stop set at 20.125, you would have sold the stock on the dip to 19.625 point B. Unfortunately, this would have been right before the stock was taking off and getting ready to double. Again, if after it ran up to 33.25 point C, you decided to move the protective sell stop up to 10% below current levels point D, for the second time, it would have been stopped out needlessly as it dropped to 29.50, assuming you had repurchased the stock after getting stopped out at point A. USX then started another powerful up leg. Instead of reaping the rewards of a powerful Stage 2 uptrend, you would have been whipsawed all over the chart and paid needless trading commissions. Horror stories like this are far too common, and are the reason that those few investors who do experiment with sell stops usually abandon them in a hurry. The protective sell stop is an incredibly helpful and profitable technique when properly used. That's what you are now going to learn. The first thing to know is that you must be flexible when you place your initial sell stop. Sometimes it will be 8% below your purchase price, other times 12% or more. The percentage will not be the determining factor. Instead, the prior support level and 30-week EMA will be your two keys to focus on. When you set your initial stop, pay less attention to the EMA and more to the prior correction low. If stock XYZ is trading in an 18.25 to 20.25 zone, and you buy it when it breaks out at 20.375, the stop should be placed right below the significant floor of support. You could set the stop at 18.125, below the 18.25 bottom. But here's a little secret that I've learned over the years which has served me well. If the sell stop should be placed right above a round number or on it, set it instead just under the round number. For instance, if the stop should be 18.128 or 18, enter it at 17.875. Psychology plays a very big part in market moves, and this is another example of herd instinct. Many investors like to buy at round numbers. If the stock is trading at 18.50 or 18.125, buy orders will often accumulate on the book at 18. Therefore, that level is a tough one to crack. If it's violated, then you really know your stock is running into trouble and you'd better exit quickly. I've seen it happen so often that the proper level for the sell stop is right above the round number, say 18.125. It hits that level, and then only a few hundred shares trade at the round number without it being violated. Then, a new rally gets going. To a somewhat lesser degree, this phenomenon also occurs at halves 18.50, 19.50, etc. So if the sell stop should be set at 18.625, place it below the half at 18.375. From now on, never hold a stock without a protective sell stop. As soon as you buy an issue, immediately enter a GTC sell stop. This way you will never be left unprotected and end up with an unpleasant surprise staring you in the face when you open the evening newspaper. Also, never enter your order to buy until after you've calculated exactly where your protective stop should be placed. By getting into this habit, you will have an additional filter working for you when you narrow down your list of buy candidates. If all of the prior buy criteria that I've outlined for you are met, and you end up with 3 great buys, you should now check out the initial sell stop levels. If stock A has a breakout at 20, and the sell stop should be placed at 17.875, then the downside risk is 11%. Stock B has its breakout at 40 with a sell stop level of 33.875. That's a downside risk of 15%. Finally, C has a breakout at 60 but a protective stop level of 56.875. Since that translates into a potential worst-case loss of 5%, all other factors being equal, stock C is your best choice from a reward and risk point of view. While there are occasional exceptions because a chart pattern is so outstanding, try to limit your purchases to those cases where the initial stop isn't greater than 15% below your purchase price. Sell stops in the real world. Now let's get to specifics so you will be sure to know exactly where your sell stop should initially be placed, and when and to what level it should later be raised. Stock XYZ was in a trading range of 18.25 to 20.25 before it broke out and moved into stage 2. You bought the stock at 203s, and the initial stop was set under the round number at 17.875. Now all you have to do is sit back and wait. In the unlikely event that the stock breaks down, you will be sold out when the 17.875 stop is hit. In the more likely and happy circumstance that your stock starts to move higher, here's what to do. As long as the stock is above its rising 30-week EMA, and the EMA is rising in stage 2 fashion, be sure to give it plenty of room to gyrate. We are going to trail the sell stop behind the advancing price in the following manner. After the first substantial correction of at least 8 to 10%, you are now going to get set to raise the stop. But you don't actually change it until your stock ends its correction and moves back toward its prior high point A on chart 621. If a break below that correction low point B would also violate the 30-week EMA, that is a valid point to which an investor should raise the sell stop. If, as in this example, the correction low is above the rising 30-week EMA, place the sell stop below the EMA point C. Continue moving the sell stop up as the EMA advances, points E, G, I, etc. In this case, the correction low is 21, while the EMA is up to 20. The sell stop should therefore now be raised to point C at 19.875 under the round number of 20. One last point. Don't raise the stop to 197s until after the stock rallies well off the low at point B back close to prior peak A. Next, the stock rockets ahead in normal stage 2 action after the first correction. After peaking near 35 point D, it corrects back to the 28 level before resuming the advance. At this point, the EMA is up to 26. Therefore, when you raise the sell stop, place it at 25.875 point E. Again, don't raise the stop until XYZ rallies to point F, which is close to its prior peak. The next decline to point G terminates right at the EMA at 32.125. After the next rally gets underway and brings the stock close to point F, the stop should be raised to 31.875 again, under the round number. In the same manner, the sell stop should later be raised to point 1 at 38.875. At this time, the last low is at 40, while the EMA is up to 39.25. Now comes an important change in tactics, so pay close attention. The EMA has stopped rising and flattened out after point I. Once this occurs, the probabilities are high that a stage 3 top is starting to form, and the next serious violation of support, and the EMA can well bring on stage 4 problems. Therefore, once a stock moves into this higher risk zone, you should become more aggressive with your sell stop. In the case of XYZ, that means moving the stop under the correction low at point K, even though it is above the MA. Since K is at 46, raise the sell stop to 45.875. Then, in the following weeks, a potential head and shoulder top forms with the neckline near 46. Since point M is at 46.50, which is so close to the 46 stop, you need not raise the stop for such a trivial change. Eventually, 46 support is broken, and you are sold out of your position with an excellent profit before a new stage 4 decline starts to take away a good portion of your gain. Using this technique, you won't end up selling at the very top eighth, which is fine, because we are dealing with the real world. But you will usually sell quite close to the high and with a substantial profit to show for your time and effort. Furthermore, you won't end up giving back the big profit as happened to those investors who failed to sell OFIN and VM software, charts 6.3 and 6.4. Instead, you will move out of your position with surgical precision just as you entered it with your buy stop. Since a stock usually drops very rapidly when it first moves into stage 4, you'll get out before the pain begins. Using sell stops results in a minimum of emotion and misgivings. Your sell will often occur without you even knowing about it, while you are busy with your workday or even on vacation. Best of all, there will be no gut-wrenching decision-making. Should you hold despite the bad news? Should you sell because your broker heard a negative story on the stock? Is XYZ now too high or getting ready to tumble? It's all mechanical and disciplined. Most important of all, we let the market make the judgment for us. And since the market is the ultimate reality when dealing with the trend, its judgment is far more likely to be right than all of our balancing of pros and cons. Enough theory. Let's look at some real-life examples so you will feel comfortable adjusting your sell stops in the future. Chart 6.22 shows Skyline Corporation when it came to life in the early 1970s. It provides us with an excellent illustration of how an investor should implement my system of trailing a sell stop beneath your stock. SKY should have been purchased in the low 20s in late 1970 when it moved above its 30-week EMA and into stage 2, point B. Initially, the protective sell stop should have been placed under the prior correction low before the breakout point A. That would have kept you from taking too much of a loss if the bullish scenario didn't work out. In the following weeks, SKY first rallied up to point C before correcting. Then the next rally took the stock up to a new recovery high point E. You should have raised the stop to point D when SKY rallied close to its prior high point C. Note that D was below both the prior correction low and also the 30-week MA. After the next sell-off dropped the stock down to the EMA and then took it back close to peak E, it was time to take further action. The sell stop should have been raised to point F below the previous bottom and 30-week MA as the stock neared its prior peak. After a sharp rally to peak G and then another dip, followed by yet another move to new highs, the sell stop should have been raised to point H. This was well below the prior low, but right beneath the rising 30-week MA. After yet another new up move that ended at point I, SKY dropped substantially. Not coincidentally, the sharp sell-off once again halted right at the 30-week MA. Once the stock rallied sharply off that low, the sell stop then should have been raised to point J. This again was below both the EMA and prior correction low. Following this disciplined method would have locked in a great profit even if the stock had gone no higher. But Skyline wasn't done with its stage 2 advance. It next rallied up to point K, dropped a bit, and then advanced to point M. Now the sell stop could be raised to L. Note that point L was well below the bottom, but was also below the rising MA. As long as the EMA is sloping upward at a sharp angle of ascent, investors should be sure to give a stock plenty of room when placing the stop. Next, you should have raised the sell stop to N, then to P. But once the EMA starts to level out and a potential stage 3 top begins to unfold, it is time to pull the sell stop up tighter. Now you should have pressed the stop up to point Q even though it was above the MA. Finally, in late 1972, close to 2 years after purchase, SKY set off its sell stop at point Q as it broke below its horizontal trend line. It soon broke below the 30-week EMA, and stage 4 trouble was ready to set in. Note that you didn't sell at the exact top, but you did catch the lion's share of the 2-year rally and almost tripled your money. While it looks like a lot of attention was needed for these sell-stop changes, just the opposite is true. Only a few adjustments had to be made over a 2-year period. The rest of the time, you just relaxed while the cycle unfolded. Furthermore, you didn't constantly worry about the news headlines and each weekend have a debate with yourself about whether you should hold or sell. Finally, and most important of all, you sold when the market flashed its clear-cut message that the supply and demand equation was turning negative. If you didn't sell, it would have been another case of up, down, profit turned to loss. Not surprisingly, the tremendous gain that took over 2 years to create vanished in a matter of months once destructive stage 4 appeared. Just as it takes more time and energy to push a boulder up a hill than for it to fall, so it is with stocks. Both gravity and fear bring things down in a hurry. Chart 6.23 of Goodyear Tire and Rubber again illustrates how investors should go about achieving relaxed, disciplined profits. GT should have been bought when it moved above 35 in 1986, point A. The initial protective sell stop should have been placed at 29.875, point B, right beneath the prior low before GT broke out and moved into stage 2. Once the stock rallied up to 50, point C, and then dropped back close to 40, it was time to get ready to raise your stop. After GT rallied substantially above that low, the sell stop should have been raised to 39.875, point D. This placed it beneath the last significant low and also below the 30-week MA. It also was below the psychological round number of 40. In the months ahead, it should have been raised to points E, F, G, H, I, and J. Then, in the October 1987 massacre, Goodyear broke below 67 as it entered stage 4. In the meantime, you should have exited at 66.875 with no questions asked and a fabulous profit in hand. Chart 6.24 of Merck illustrates that even if the stock slightly penetrates the EMA along the way, you can still stay with it. However, this is only true if 2 important criteria are met. First, the EMA must still be rising. And second, the prior correction low must not be violated. If you bought Merck back in 1985 when it moved above resistance in the low 60s, your initial stop should have been set at point A. Then, as it rallied after correcting along the way, the protective stop should have been raised to B, C, D, and so forth. As you can see, the sell stop was always kept below the EMA even if the correction low held above it. This is an important point for investors to keep firmly in mind, because the trader's way is quite different. After you raise the sell stop to point E, Merck rallied to a new high before selling off sharply and temporarily nudging below the 30-week MA, but it didn't break down far enough to set off the stop at point E. After a lengthy consolidation that took place as Merck moved between support in the high 90s and resistance near 115, the stock broke out on the upside once again. The stop then should have been raised to point F. In the following months, after each correction, the protective stop should have been raised further to points H, I, and J. Then, in October 1987, MRK finally hit its sell stop when it broke below 190. While you didn't get the exact high, you came darned close and in the process tripled your money, which is nice work when you can get it. This method of protecting your profits and limiting your losses is really fabulous. It will add immeasurably to your market success over the years, but don't expect it or any other technique that I teach you to be perfect. There will always be a few failures and whipsaws along the way, which is simply a cost of doing business. This lack of perfection is a small price to pay for the disciplined approach to scoring big profits that you are going to utilize. Chart 6.25 of Walmart stores provides us with one of the whipsaw cases that come along now and then. If you had bought Walmart near 15 back in 1985, you should have initially protected it with a sell stop set at point A. In the following months, the stop should have progressively been raised to B, C, D, and E. Unfortunately, in late 1986, the stock broke down below support at 22. Even worse, it clearly broke below the 30-week MA, which was no longer rising. It certainly appeared that WMT had completed a stage 3 top and was starting a stage 4 decline as the protective stop at 21.875 was set off. True, you had locked in a decent profit, but in the following months, Walmart reconsolidated and broke out on the upside again as it moved above resistance at 25. It was now clear that the breakdown was a false one and the probabilities favored the start of a new advance. There is absolutely nothing wrong with occasionally getting whipsawed out of a stock in this manner, and then rebuying it a few points higher once the danger signals have vanished. Look at those few points you gave away as the cost of insurance. Just as you pay premiums to protect your house against fire and theft, so too, it is worth protecting your stock position against stage 4 destruction. In this case, after making about 7 points on the first transaction, you then should have moved back in as the stock powered above 25 and moved to new heights. This time your new initial stop should have been set at point F and raised progressively in the following months up to point I, right below 35. Then in October 1987, when that sell stop was hit, you could have exited with a second fine profit, while so many others were scratching their heads and wondering what to do while the market plummeted. The case of Walmart would have taken you through whipsaws and some frustration, but you would have walked away with 2 fine profits. What will really make you tear your hair out is to completely lose a big profit and actually end up with a loss. This experience is as painful as it is unnecessary. At the beginning of this chapter, I showed you several examples of such easy come, easy go cases. Intologic Trace, chart 626, is another stock that fits in that category. But now that you know how to properly use sell stops, you'll never again be caught in that position. Many investors bought Intologic Trace when it flashed a buy signal by moving above 8.125. Unfortunately, more than a few who rode the stock on its heady ascent, JUST didn't know when to get off. They lost all of their profits and actually ended up with a loss. From now on, the only roller coaster rides that you take will be at the amusement park. If you bought IT when it broke out above resistance, you initially should have protected the stock with a sell stop set at point A. In the following months, you should have raised it as shown on the chart. Once the EMA flattened out and the stock broke below its sell stop, you should have been glad that your sell stop was activated because you locked in a great gain before trouble set in. You didn't get the exact high, and it's unlikely that you ever will, but you did score a terrific profit in a matter of months. And more importantly, you sidestepped the vicious stage 4 decline that would have turned your big gain into a loss. To avoid just one of these ulcer-producing reversals, and believe me, there'll be plenty, is more than worth the price of the occasional whipsaw. The trader's way. Several of the questions most frequently asked of me have to do with trading. How do you define a trader? Should you trade? Why bother trading? Is it better to invest or trade? Those of you who are veterans of the market battle know if you are more inclined to trade or invest. But newcomers often are perplexed about which road to take. Surprisingly, even some seasoned market players are confused in their approach. They may consider themselves investors, but actually have a trader's psyche and therefore do poorly. So before getting into the proper way for traders to time their sales, I want to wax philosophical for a moment. I don't really believe there is one absolute truth about whether it is better to trade or invest. I know many very successful traders, and there are certainly scores of winning investors. What I do know is that it is easier for most market players to win big by following the investing path to profits, especially new market participants. It involves less time commitment, less skill, and is certainly easier on your emotions. So why should anyone even consider trading? Simple. Traders need the challenge and the action. Whereas most investors are more conservative by nature and like to keep their lives relaxed and calm, traders are more inclined to live on the edge. They enjoy the thrill of battle and the competitive tensions that come with making decisions on the firing line. Don't waste your time trying to determine if trading or investing is the best way to make money. There is no one best way. Either approach can lead to success if skillfully applied. Instead, give some thought to understanding the kind of person you are and which approach you'd be comfortable with. Use a little introspection to find out what cloth you're cut from, and then become the best damned investor or trader that you can be. It leads to disaster if you decide to invest, but then get so angry because your stock dropped 6 or 7 points that you end up dumping it just before the next up leg. So have an honest talk with yourself. If you obviously belong in one area or the other, then get there. Interestingly, there really are a number of market players who are in the middle and can adopt either approach. If you fall into this category, I suggest a mixed approach. Favor the investor's way, but do some trading if the market indicators, which I'll teach you in Chapter 8, signal the strong likelihood of a stiff sell-off. Also consider taking some fast profits if your stock skyrockets in a hurry and becomes very overextended, if it moves far above its 30-week MA. In such a case, it makes sense to lock in the huge gain on 0.33 to 0.50 of your position and ride the rest with a trailing investing sell stop. So much for philosophy. Now let's dig our teeth into some specifics. Just as there are clear-cut rules for investors, so there are for traders. These rules are a little less rigid because you've got to be ready to turn on a dime, but there are still definite guidelines to follow. The first trading technique to perfect centers on the trailing sell stop. Traders must be much more aggressive than investors in their use of this tool. Investors ideally want to stay with a position as long as the stock is in stage 2. They accept the reality that there will be some pretty stiff setbacks along the way. In addition, months may go by when the stock moves sideways and consolidates before moving higher. Traders, on the other hand, realize that time is money. They not only want to sidestep all significant declines, they even want out if the stock is entering a neutral zone for several months. This makes sense because they can shift into a new stock that is ready to move into the exciting part of its cycle while the old situation simply zigs and zags. Therefore, a trader shouldn't wait for the 30-week EMA to be violated on a sell-off before selling. In fact, if he can time the sale nicely when XYZ is well above the MA, the trader will often repurchase on dips back close to the MA. Just as we did with the investing case, let's study some specifics to better understand this concept. Stock XYZ in chart 627 broke out at 20.375 after trading for several months in an 18.25 to 20.25 range. Once again, the stock should be purchased at 20.375. But in this case, the initial stop should be handled differently. As a trader, you're looking for a faster but smaller upside move, so you should be willing to take a smaller initial loss if wrong. If the stock is going to be an A-plus trade, it shouldn't drop significantly below the breakout point, so you should set the stop under the closest prior reaction low. If there isn't any, then you can play the following numbers game. While investors should never use automatic percentages, years of experience have demonstrated to me that those breakouts that are going to be big winners in a hurry almost never pull back more than 4 to 6% below the breakout point. So if you can't find a nearby meaningful sell stop point, you can place it 4 to 6% below the breakout level. However, make sure it's beneath a round number. For instance, if the breakout is at 20.375, 4% is a little more than 0.75 of a point, which is 19.625. 5% yields 19.375. Since 19.50 is psychologically like a round number, the position should be protected with a 19.375 sell stop point A. Under $20, consider each VI point a round number, but above $20 place the sell stop under an actual round number such as 21, 22, etc. Thereafter, XYZ moved up to its first rally peak at 25.B before declining to 22.C. Traders shouldn't pay attention to corrections of less than 7%, only deal with the more meaningful moves. Once your stock held at C and rallied back close to the prior top point B, you should have raised the sell stop to just under point C, 21.875. Remember, if the prior low was at 22.125 or 22, the sell stop should be set below the round number at 21.875. In the weeks ahead, XYZ rallied up to point D near 30 before dropping back to point E, 25.50. Again, when XYZ rallied back up close to point D, the stop should have been raised up to 25.375, right under point E. In the same manner, the stop later should have been tightened to 29.875 G. Eventually, after a double top formed at peaks F and H, you were stopped out of the entire position at 29.875 for an excellent gain in a hurry. One thing to always keep in mind is that a trader should never stay with a position if it breaks below the 30-week EMA by even a fraction. Chart 628 of Reynolds Metals, RLM, shows how trading sell stops should be used in the real world. The stock should have been bought for a trade at 25.50. It broke out of a continuation pattern after an impressive build-up in volume. Initially, the trading sell stop should have been placed at 23.875 under the round number of 24. RLM then shot ahead in a hurry to 37.375 B before undergoing a significant correction that dropped the stock to 31. After Reynolds rallied back close to its prior peak at 37, the stop then should have been raised to 30.875 C. Later, after a rally to 40 was followed by a 7% correction, you should have prepared for your next move. As RLM moved back to its high, and then certainly as it surpassed it, the stop should have been raised to 367.D. Thereafter, Reynolds embarked on another straight-up advance that reached 54.25 before the next meaningful correction unfolded. RLM bottomed, not so coincidentally, on the round number at 49. It then moved back to its prior peak. In addition, RLM formed a 5-week neutral pattern that saw the stock drift sideways. After a substantial advance, this is always a worrisome trading sign. The trading sell stop should therefore have been pressed even further to 48.975 While it isn't as obvious on a weekly chart, 628, as on a daily chart, 629, a small head and shoulders top pattern also formed. Therefore, once RLM broke below significant support at 49, it was time to take the nearly 100% profit that you earned in 6 months, 200% annualized. Didn't matter that Reynolds dropped below 45 and then moved back above 50. The dynamic upside momentum was now a thing of the past, and a trader, unlike an investor, only wants to hold a position when all rockets are firing with full thrust, trending toward profits. The trading sell-stop technique that I just outlined is simple to use and will produce good profits on a consistent basis. But if you want to move to an even higher level of sophistication and score larger gains, you should learn to use trend lines and incorporate them into your trading plan. In many cases, no valid trend line will form and you should simply use the trading sell-stop concept. But when an aggressive trend line does take shape, use it, because it's a way of locking in even more of the profit. At least a portion of the position should be sold when such a trend line is violated. Then the remainder can be handled via the sell-stop route, which will usually be at a somewhat lower level. When integrating trend lines into your trading game plan, start out in the same manner as you did in the prior example. Set the initial stop at 19.375 when you buy on the breakout at 20.375. Then raise the sell stop to B as the stock rallies back toward peak G. A clear-cut trend line is one that connects at least 3 points. If a trend line materializes, it should be brought into your analysis of where to place your stop. After XYZ rallied off of point C, the sell stop should be placed under C. Here's where the trend line can start to help you. Now that it's been in force for several months and has been touched at least 3 times, you should raise the stop further to a point under the trend line. First, you'll raise it to D, then a few weeks later to E and F. Since the trend line is a rising one, you can continue raising the stop on this half of the position even if the stock moves sideways, as it did following point I. One half of your position is now protected with a stop at point C, and one half is set very tightly at rising points D, E, and finally F. Eventually, the sell stop at F is set off as the stock drifts sideways. Even if it doesn't indicate a sharp drop, it's likely to lead to a neutral trading range. This is bad news for traders, so it's good to lock in the profit on half the position. Then, when real weakness sets in, the second stop at point C is hit and another fine gain is secured. Charts 631 and 632 of Computer Sciences, CSC, and Tultex TTX illustrate the advantages of using trend lines. CSC should have been bought for a trade when it moved above its downtrend line and above resistance at 38. The initial stop should have been placed under the round number of 36. Then, after a move above 40, followed by a reaction to 37.375, the sell stop should have been raised to 36.875. Until this point, nothing has deviated from the trailing sell stop method that we've outlined for traders. Now, however, things start to change. You can draw an upsloping trend line that connects more than 3 points numbers 1, 2, 3, and 4 on chart 631. That line should have been penciled in and extended into the future. Not so coincidentally, in the weeks ahead, computer sciences hugged that line and kept trending higher. We now know for sure that we have a meaningful trend line on our hands. Therefore, the stop should be continually raised for at least half the position under the rising trend line. Be sure to keep it under the psychological round number. If you want to be very aggressive, you can use only one stop under the rising trend line. If you'd rather be a bit more conservative, it makes sense to press the stop for half the position very tightly under the continually rising trend line. The stop for the other half of the position should be placed under the last correction low. Interestingly, after CSC had a 7-month run on the upside, from the purchase price of 38.125 up to 61, the two sell stops approached each other. In late April and early May of 1987, the trend line was up to 57.50, so one half of the position should have been protected with a 56.875 sell stop. The stop for the other half should have been set at 54.875 since there was good support right above 55. In May, both were set off and a fine profit was locked in. Note that the stock didn't get smashed. It dropped to 49.25 and rallied back above 55. The important reality to be aware of is that the trader's purpose was well served. In the 6 months that he held the stock, it continually trended higher as it racked up a very tidy gain. But 4 months after the sell stop was set off, CSC was only a bit higher than where it was sold. Since, as traders, we only want to be in the stock when it's thrusting higher, the trend line correctly showed us when the ride was over and it was time to exit. Chart 632 of Tultex TTX is another good example of trading with the help of a meaningful trend line. TTX should have been bought at 5.50 when it broke out above its downtrend line in late 1985. Starting in early 1986, point 1 on chart 632, an important uptrend line formed that hit 2 more points 2 and 3 over the next 3 months. It then touched the line 2 more times points 4 and 5 over the next 4 months. So in addition to your use of a trailing sell stop, this very meaningful trend line should have been factored into your trading game plan as the move unfolded. When it broke below the trend line at 13, the first half of the position should have been stopped out for a better than 130% gain in 8 months. Then, when the prior correction low at 12.50 was violated, the remainder of the position should have been closed out. Again, the stock did not turn into a stage 4 disaster. It's very meaningful that in the 8 months before the trend line gave way it was up, and away. But 8 months after the break, Tultex was 1.50 points lower than where you got out. Listen to the message of the trend line, because it tells you when the upside momentum is ebbing and the air is starting to leak out of the bullish balloon. Measuring the move. Before leaving this section on trading, there is one more little-known trading technique that will improve your trading skills. Over the years, technicians have come up with all sorts of fancy theories and games that are supposed to predict where a stock is headed. Believe me, I've dabbled with them all, from the simplest to the most complex. I'm not going to burden you with them because it's not worth the effort, but there is one simple concept that you should be aware of that does have a high degree of accuracy. When you add it to your arsenal of trading tools, you'll really be ready for the firing line. This trading measurement is called the swing rule. It doesn't appear often, but when it does, it can give you real insight into where an advance is likely to end. It's often so accurate that it's almost like reading next week's newspaper today. All you have to do is take the peak price before an important decline sets in and subtract the next low price from it. In chart 633, you'll see that since XYZ peaked at 26 and the low formed at 16, you get a difference of 10 points. 26 point A minus 16 point B equals 10 points. The next step is to add the 10 points onto the peak price of A once XYZ betters the old peak of 26. So 26 plus 10 points equals 36. This level becomes a potential near-term target area. Obviously, this is just an approximation. The move may end at 35 or 38, but as you near that area, it pays to be alert for signs that a near-term top is forming. Eyed and eyed, chart 634 reached a peak of 27.625 in 1986, point A, before breaking to the downside. When the destruction was over, the stock had been smashed to a low of 17.50, point B. AYD then broke out above resistance at 25 in early 1987. This move above the neckline also completed a head and shoulder bottom. The stock was soon marching to a very nice tune as it moved above its 1986 peak of 27.625. The swing rule yielded a difference of 10.125 points. 27.625 minus 17.50 equals 10.125. We could now make an intelligent guess as to how high AYD might go before it would run out of gas. Add the 10.125 points onto the peak of 27.625, and you get a target of 37.75. As the weeks passed, AYD moved closer and closer to that level before topping out and breaking below the uptrend line at 33.875. And what price do you think the top at point C turned out to be? No, it wasn't our projected 37.75, but 37.50. Not bad. So the best way to use this swing rule is to do partial selling of your trading position as close to the projected level as possible, and then sell the remainder when the stop is set off. In this case, it would be at 33.875 when the price broke the trend line. To show that AYD was no isolated occurrence, let's study the action of Reebok, chart 635. The mid-1986 high was 17.625, point A. It then dropped down to point B, which turned out to be 10.25. Subtracting 10.25 from 17.625 gives us 7.375 points. Add the 7.375 points to the prior peak of 17.625, and we get a trading target of 25. The move actually ended at 25.25, point C. Finally, check out the action that unfolded in Tiger International chart 636. It flashed a buy signal in late 1986 when it moved above. But before that, it dropped from its 1985 peak of 10.50, point A, down to 3.625, point B. That's a differential of 6.875 points. To get an upside trading projection, add the 6.875 onto the previous peak of 10.50. Applying the swing rule yields an upside projection of 173s. Incredibly, the actual high for the move turned out to be 17.75, point C, before TGR quickly fell below 6. While every swing rule projection won't turn out to be as perfect as these, the overwhelming majority will be surprisingly on target. So when trading a stock that gives you the opportunity to use this fabulous measuring device, take advantage of it. Sell at least a part of your position near the projection, then let your stop take you out of the remainder. By combining the proper use of sell stops with trend lines and the swing rule, you are ready to do some disciplined and profitable trading. Learning how to win by learning how to lose. No matter how good my system is, you will not win 100% of the time. That's a promise. How you deal with this fact of life will go a long way toward determining how big a winner you become. In fact, after all my years in the market, there is absolutely no doubt in my mind that one of the real keys to winning is learning how to lose. Think about it for a moment. Is it really so terrible to take a loss on one or two positions? To most people it is, and that's why they end up making poor decisions. But to market professionals, it's a fact of life, a cost of doing business. Specialists and other pros don't lose sleep if a given position ends up in the loss column. They concern themselves with two far more important factors. One, the net result of all their positions as long as it is strongly positive they are happy. And two, where they will call it quits if a given stock moves against them. This is the mature, rational, though rarely practiced, way to approach the market. When you play tennis, you honestly expect never to hit a ball into the net. If you're a realist, you accept that some of your shots will misfire, and you don't get upset as long as you have a far larger percentage of match-winning shots. Training yourself to think this way is crucial. I'm sure you've seen, as I have, the person who blows sky high over a poorly hit tennis ball or a missed putt on the golf course. Emotions are destructive if you don't deal with them properly. I've seen market players do reasonably well, especially in a bull market, only to have a single bad position undermine their entire strategy. Instead of realizing that the first small loss is the best loss, they get angry and stubborn as their stock plummets. When it's fallen to a level that appears cheap, they average down, throwing good money at a bad stage for position. Even worse, as losses start to mount, the next destructive step is to start taking profits in those stocks that are still winners. In the short run, this makes the investor feel better as he makes several entries in the plus column. But in the following months, the portfolio will reflect the effects of this short-term fix. Very simply, this ill-conceived strategy loads up your portfolio with stage 4 losers while you discard stage 2 winners. What drives us to this destructive behavior? In one word, ego. Too many traders and investors feel that if they pick a big winner, they are a genius, but if they lose, they are stupid. Neither is necessarily the case. If you win through poor tactics, you lucked out in spite of yourself. And if you took a loss but followed a solid, disciplined approach, you acted wisely. Have a long talk with yourself and make sure your ego is under wraps when you make market decisions. Don't play the market so you can brag at cocktail parties about your winners. Invest your time and capital in the market because you enjoy the challenge of making a nice return. The destructiveness of ego can be seen day after day. Sit around any brokerage office and listen to the conversations. You'll hear people saying that they are going to sell that dog just as soon as it gets back to where they are even. Why even? Why not when it rallies back to overhead resistance, even if that involves taking a small loss? For ego-driven investors, even means I wasn't dumb. Their self-esteem is tied to their wins and losses. When they lose, this personality type just has to blame someone else, any handy scapegoat. And who's more handy than the broker into whose lap all blame is dumped? We've all come across some less than brilliant brokers, but brokers can't make you buy or sell a stock, and they can't make you stick with them even if they're truly incompetent. Ultimately, it's always your choice, so it's important that you learn to take responsibility for your actions. If those actions are positive, reinforce them. If they are negative, work to understand and alter them. Always be certain that you are in the driver's seat, not your ego. An extreme example of how potent the mixture of ego and trading failure can be occurred in Miami during the historic October 1987 crash. An investor who suffered severe losses shot and killed his broker before killing himself. Promise yourself that you won't allow any one loss to be blown out of proportion. First, treat your portfolio like a mutual fund. Look at the overall return of the whole. Second, make a pledge that you'll never hold any stock long or short without a protective stop. This will take the emotion out of the situation and guarantee that no single position will cripple your portfolio. Now let's study some real-life situations that I had to handle in the professional tape reader. While it's more fun reviewing the action of our many big winners, it's important to learn how to cope with situations that backfire. I recommended American Capital Management Chart 637 in January 1987 when it broke out above final resistance at 24 and the relative strength moved into positive territory. All systems appeared to be go, but instead of moving higher, ACA went into a stall. For the trader, this is always an important warning. If a stock doesn't come out of the gate strong on the breakout, a trader should immediately lighten his position while protecting the remainder with a very tight stop set about 5% beneath the breakout, under a round number. In the case of ACA, that would translate into a sell stop at 22.875. So for traders, the loss was really minimal. Even investors can use a little common sense and lighten up when a stock fails to move above the breakout level. In the meantime, the investor's sell stop was set right beneath the moving average at 22. Therefore, the position was closed out for a 9% loss once the stock started to weaken. If this discipline hadn't been followed, a small loss would have turned into a 65% disaster, as ACA hit a low of 8.25 several months later. Chart 638 shows another potential winner that turned sour. Roland's Environmental, REN. Once again, there was no serious problem as our method handled the curveball very nicely. Roland's gave a continuation buy when it moved above final resistance at 23.50. After moving to 26, it quickly pulled back below the breakout at 23.50, which was a good reason for traders to get out with a fractional loss. Stocks that turn into great trades rarely drop back below the original breakout point. For investors, the stop should have been placed at 21.875, since the prior lows were right above 22. This is where I placed it in PTR. In addition, the 30-week EMA was at 22, so when REN broke below 22, it was time to say goodbye to the position with a 7% loss. A few weeks later, That exit point almost looked like a profit as the stock plummeted to 11.50 for what could have been a 50% plus loss. The lesson is obvious. Protect all of your positions with stops, and don't ever make an exception because a certain stock is a special situation. The philosophy of selling, or don't give back profits needlessly. It's not enough to understand the mechanics of selling. You must also understand the winning philosophy that accompanies the methodology. Most market participants view profits and losses in a way that I can only categorize as strange. Their view also makes for odd and destructive decisions. Ask 8 out of 10 investors who bought stock XYZ at 40 how much they've lost now that the stock is down to 20, and they'll answer nothing. The conventional wisdom says that as long as I don't sell the stock, I haven't taken any loss, or it's just a paper loss. That's ridiculous. Your stock is only worth the price of the last print on the tape. It's an asset that can be sold anytime the market is open. If you decide to cash in your chips on any given position, you can take that money and do as you wish with it. But because of this nonsensical view that a stock in which they are losing 50% is not a loss, they hold and hold, waiting for it to come back to even so they won't have to feel stupid. Not only are they suffering needless additional shrinkage of capital, they are missing out on the chance to shift the funds into new Stage 2 situations. The converse is also ridiculous. If they bought a stock at 40 and it's run up to 80, they feel they don't have a profit because they haven't sold yet. Instead, they talk about playing with their money. They should recognize that they have real profits that will be lost if not properly protected. Once you redefine your thinking in this manner, you automatically start to act differently. Think about it. If you buy 1,000 shares of XYZ at 40 and it advances to 80, your $40,000 is now worth $80,000. You can take that money and move into another stock. If you want to use it as a down payment on a house, that too is your choice. And if you don't tend to business and allow your stock to fall from 80 back to 40 because you didn't use a sell stop, you lost $40,000 of your hard-won assets. I strongly suggest that each weekend you tabulate the value of your portfolio. Don't worry if it swings a few percent from week to week. That's the way of the market. But if you see your assets drop by 20 to 25%, something is wrong. If you're using sell stops, perhaps you are taking too much risk by buying stocks that are too far above their stop-loss points. If that isn't the case, then it's possible that you are taking far too many small losses in a row because the negative market climate is whipsawing you in position after position. In such a situation, just move to the sidelines until the probabilities of success become favorable. In Chapter 8, I'll teach you how to keep in touch with a few easy-to-calculate indicators that prevent this. But in the meantime, by continually tabulating your results, you'll take significant changes in your assets more seriously and never allow profits to slip away. Look at Chart 639 of TS Industries, which got bashed in the October 1987 crash, and you'll see what I mean. Many investors who had accumulated large profits lost it all, plus some. If you had stayed on top of the stock, there was absolutely no excuse for that to happen. I recommended TNDS in PTR in early 1986 when it was below 10. It rose in perfect Stage 2 fashion for the next 1.5 years, never once violating its rising 30-week MA. It didn't even violate any minor support levels in that entire period. Then, in late September 1987, the stock hit a high of 34.50 after having established a solid base of support, right above 31. Since the EMA was losing upside momentum and leveling out, I raised the sell stop to 30.875. A few weeks later that stop was touched, and the stock was closed out for better than a 200% gain. What is even more startling is what happened to all of those investors who had no game plan, and to those market players who thought they could continue to give TS Industries plenty of room to gyrate. In the few weeks after I closed out the position, the stock dropped a sickening 92%, hitting a low of 2.75. In 3 weeks, the entire gain of the prior 2-year advance was wiped out. This is the sort of market nightmare that you'll never have to lose sleep over as long as you faithfully practice the discipline that you now know. Chapter 7. Selling short, the less traveled road to profits. Although the market for stocks is upwardly biased when viewed over long periods, a good 1/3 of the time it's headed down. This also applies to individual stocks. Most investors view this downward phase as a time to be out of the market or out of particular stocks. They content themselves during this time with the paltry return offered by banks and money market funds, awaiting the end of the so-called bad market. Individual investors aren't the only ones who spend long periods sitting on their hands. Their brokers are no better, just more dangerous. They fill their days and earn their commissions during down markets by recommending buys on fallen stocks that usually still have a good distance yet to decline. This chapter is one of the most important in the entire book. It's about short selling. Read it carefully and with an open mind. If you're unfamiliar with the concept of short selling, go back to the definitions on short selling and breakdowns in Chapter 1. It never ceases to amaze me how many market players refuse to sell short. Many won't give it a moment's thought. They would no more short a stock than put the deed to their houses on 00 in a Vegas casino. They view it as being that risky. Therefore, it's understandable why they react so negatively when the subject is broached. But those fears are unfounded, and they are actually losing out on a chance to make a great amount of money in a hurry. It's a statistical fact that stocks decline faster than they rise. So if you learn how to capitalize on these smashes, you'll be way ahead of the game. Stocks fall apart much faster than they rise because fear causes a panic reaction, while greed takes a while to simmer. These two vulnerable charts, 7.1 and 7.2, were recommended as short sales in the professional tape reader. They clearly show the profitable chemistry that occurs when you mix a negative technical pattern with a bear market. Many people are optimists, and it's against their nature to try to profit from negative situations. But if you only play the long side of the market, it's like driving a car that has only a forward gear. Even though you need that gear a much greater percentage of the time, it's dangerous not to have reverse for those few occasions when you need to back up out of a jam. The same applies to the stock market. Over time, bull markets predominate over bearish ones. For example, between 1960 and 1987, only 8 of the years were bearish. But to have misplayed those years would have taken away a large portion of your gains. Not to have capitalized on the bear markets by selling short would have handicapped your portfolio still further. The simple and logical way to approach the market is to learn that just as the best stocks should be bought in a bull market, the most vulnerable ones should be sold short in a bear market. Why is short selling so feared? If you follow my rules, I believe you'll see that short selling presents no greater risk than does buying. If this is the case, then why do so many people refuse to sell short, and why are they absolutely phobic about this very important and profitable technique? Here are a couple of the most common answers that I've heard over the years. Many investors feel it's un-American to sell short. They believe we have to root for our companies to do well. They seem to think it is similar to cheering for your local baseball or football team, and they don't want to be disloyal. Since most Americans have a natural tendency toward optimism, short selling is often viewed as a negative pastime. My reaction to the above is simple. There is absolutely nothing wrong with recognizing the reality of both the marketplace and economy. Cycles are a fact of life, and there is nothing patriotic about holding a stock while it enters a stage for decline. In the same way that it's rational to sell and avoid a large loss when a stock starts to crash, it's also reasonable to profit from that decline. Also, short selling actually serves a very valid economic function. Short selling increases the stock's liquidity on the downside, so when an issue gets smashed, its decline is eventually cushioned. After all, a person who has sold XYZ short has to repurchase that stock at some point. Every short sale represents future demand for the stock. When it declines and short sellers buy back the stock, this demand actually slows the drop. Finally, none of the professionals with whom I speak ever view short selling as unpatriotic. More importantly, they sure don't refrain from doing it themselves. I may be overly cynical, but I really don't think most professionals are unhappy that the public has bought the un-American bit, thus leaving the shorting arena to them. A second bogeyman that keeps so many from selling short is that classic excuse: you can lose everything you have. Thinking or non-thinking goes something like this: if you buy XYZ at 40, the worst that can happen is that the company goes bankrupt and the stock ends up dropping to 0. But if you sell short, there is no upside limit. It can advance toward infinity. Since infinity brings to mind the size of the universe and other imponderables, this theoretical danger is enough to make most investors stop right in their tracks. They dismiss the idea of short selling and go back to what they perceive as being safe, such as buying stage 4 patterns in a bear market. While there is a remote theoretical possibility of a stock jumping higher and higher, thus wiping you out while you are short. There is zero possibility of that happening when you follow my methods. You've now read and digested enough of my approach to know the answer even before I tell you what it is: a protective buy stop. This device will guarantee that you never suffer the horrible fate of infinite loss and eternal pain and suffering. It's no different from what I taught you on the buy side. In the same manner that a properly placed protective sell stop will make it impossible for you to ever carry any stock from 40 down to 0, so too will an intelligently placed protective buy stop assure that you'll never hold XYZ short as it advances from 40 to 200. Once you learn how to implement this important tool, you'll quickly see that it's nonsense to listen to your friends and relatives who warn you against the evils of shorting. You won't lose the house, car, and even the kids, as so many amateurs fear. On a worst-case basis, you'll suffer a 10 to 15% loss on a position that moves against you. This is no different than what happens on the long side when one of your purchases doesn't work out and your sell stop is set off. Once you learn to view the market properly, you'll see that it is a simple numbers game. There is absolutely no difference between buying stage 2 stock XYZ when it breaks out at 40 and protecting that position with a 35.875 sell stop, and selling short stage 4 stock ZYX at 40 and protecting it with a 44.125 buy stop. In both cases, you have a 10% loss if the position goes against you. Forget about the unlimited risk nonsense. With my method, you will never carry a long to 0 or a short to infinity. Common mistakes when shorting. Before showing you the correct way to sell short with big potential and minimum risk, here are some of the most common mistakes that investors make on the short side. 1. Using overvaluation as your criteria for shorting. Don't ever fall into the trap of thinking that a high P/E means you should sell short. I've talked about the subjectivity of overvaluation before. It's such a fuzzy concept when considering short sale candidates that you should swear off of it entirely. I could fill up page after page of this book with examples of stocks that look to be too high based on their P/E ratios, but went much higher in the months ahead. Chart 7.3 of Data General looked fundamentally attractive to sell short in early 1984 when that junior bear market started. It was selling at an astronomical 35 times earnings, and the market looked ready to get hit. But during the next 8 months, while the Dow Jones Industrial Average shed over 200 points, DGN rose from 30 to close to 60. This stock was in a solid stage 2 uptrend, and you already know not to even consider shorting a stock in that stage. Interestingly enough, there are many stocks that move into stage 4 and turn out to be really big winners on the short side even though they have low P/Es when the sell signal is given. Wayne Gossard Chart 7.4 was selling close to 10 times earnings in late 1972 when it flashed a sell signal by breaking below 11. 1 year later, it was at an even lower P/E as the stock crashed to 4.25. The lesson is clear: fundamental overvaluation is not the way to uncover a choice short sale, even though it is the most common method among the rank and file of market players. 2. Selling short because the stock has advanced too far. Another very destructive approach used by many traders and investors is selling short when they feel a stock has run up too far. If you like Russian roulette, this is your kind of game. But it's just a matter of time until the gun goes off and you get hit with a huge loss. People who play this game are selling short while the stock is charging ahead in stage 2, and then they can't understand why they get clobbered. But now that you understand stage analysis, you can see why they get their heads handed to them by trying to guess a stage 2 top. Chart 7.5 of Angelica is a perfect example of what can happen when you play this guessing game. In April 1981, at the onset of a bear market, Angelica had more than doubled and was at its high at 14. 8 months later, it was up to 25 despite a 200-point drop in the Dow. 3. Falling for the sucker short. The stock market has the equivalent of a too good to be true offer. We've all seen cases where you know that the deal is just too good to be offered for such a pittance. A closer investigation usually reveals that your instincts were correct, and there really are no free lunches. In the market, this takes the form of a sucker short. This is a stock that has risen so far in excess of its apparent sensible value that it seems destined to fall. Every market cycle has a number of sucker shorts, and they end up doing a nosedive, but usually long after you've been squeezed out of your short position for a great loss. Such stocks combine both factors that I've cautioned you to avoid: a high P/E and a sharp advance. In addition, The stock usually gets a lot of media attention because of its eye-popping run-up. Finally, and most dangerous of all, it has a very large short interest too relative to the average daily trading volume. Whereas many stocks have a short interest equal to 3 to 4 times the average daily trading, which is on the high side. These two obvious shorts often have a short position 5 times or more the average daily volume. Before examining 2 case histories that show just how dangerous these sucker shorts can be, you should know where to get the short interest figures. Once a month, around the 21st, the New York and American stock exchanges compile the latest totals on the stocks with the largest short interests. These numbers are reported in the Wall Street Journal Chart 7-6, Column A, along with the average daily volume, Column B. If you divide Column A by Column B, you get the ratio. For instance, Home Shopping Network's short interest is 4,283,306. The average daily volume is 137,595. The ratio is then a whopping 31, 4,283,306, divided by 137,595. Both Boehmer in 1972-73 and Home Shopping in 1986-87 illustrate exactly what I'm talking about. Back in the early 1970s, Boehmer Chart 7-7 rose from 2 to 10, then 15, then up to 20. It was wild, and every time a few more points were tacked on, more and more fundamental reports came forth showing that the stock lacked substance and was destined to crash. The fundamentalists were right, because even if the pocket calculator that Boehmer produced ended up on every desk in the country, the stock was still getting pricey. What these analysts and the many market players who sold the stock short didn't understand was that as long as BOM was in stage 2, high could become much higher. The second factor they failed to take into account was that so many people were shorting the stock. It attracted almost 250,000 shares on the short side. That was about 10 times the average daily volume. By itself, such an abnormally large short position can propel the stock higher as the shorts scramble over each other to repurchase the stock whenever it begins to rally. That's exactly what happened as Boehmer advanced to 30, 35, and 40. Week after week, more and more short sellers got wiped out as the stock climbed to a peak of 45 and even defied the first 10 months of the 1973 bear market. Of course, now that you understand stage analysis, you should see that there is no way you would ever have been short throughout 1972 and 1973, simply because the long-term EMA was rocketing higher. Never forget this point. Don't ever short a stock that is above its rising 30-week EMA. If you understand all that I've taught you about buying, then you know how to sell short, you just don't realize it yet. Everything is simply reversed. Just as you should never buy a stock that is trading below its 30-week EMA, you should never sell short any stock that is still above its rising 30-week EMA, no matter how enticing it may seem. As an interesting sidelight, after topping out in late 1973 near 45, Boehmer later broke below its EMA, and the EMA turned down. By now, most of the shorts were ruined and disgusted. They didn't want to hear about the stock. Following the market's perverse way, Boehmer then crashed over the next 2 years, dropping below $1 per share. Home Shopping Network, Chart 7-8, is another example of a sucker short, but of more recent vintage. Chart 7-8 doesn't do full justice to the incredible fireworks that occurred in 1986 and early 1987 in that stock, because it split twice, which equals a 6-for-1 stock split. But one glance at the graph should give you an idea of how the short stomachs were churning. The initial public offering IPO was at 18, and the stock closed the first day at an unbelievable 47.75. Now the game was underway. Investors who got in at 18 had over a 150% profit the first day the stock started trading. In the next few sessions, it shot ahead to 50, 55, 60, then 65, and that was only the beginning. Now prospective short sellers really started coming out of the woodwork. To them, the stock had to come down. So the short interest built up to over 10 times the average daily volume as more and more speculators bet on a crash. In the meantime, brokerage reports declared that the stock was overvalued, but it was in stage 2 and the short position was too high. So what happened? The confoundment of the short suckers, HSN rose vertically from 100 to a per-split peak of 282, which equals 47 on Chart 7-8 when adjusted for the splits. Then, as is usually the case, After all of the too early short sellers got wiped out, the stock finally topped out and broke below its moving average, tumbling all the way back down. Other short-selling errors. The three types of shorting errors I've just pointed out certainly aren't the only ones you must be aware of when looking to make money on the downside. It's also important that you don't sell short a stock that is too thin. By too thin, I mean an issue that has relatively little trading volume each day. If the average weekly volume is under 15,000 shares, look elsewhere. Remember, if it trades only a few hundred shares a day when you try to cover the stock repurchase your shares, your buying will cause the price to rise. In addition, when a stock trades thinly, it doesn't take much buying to panic the other shorts, causing a short squeeze shorts trying to repurchase their shares, thus driving the price higher. Another grave error is to sell short a stock that is part of a very strong group. All the principles that I've taught you on the buy side still apply, but in reverse. You want to sell short a vulnerable stock that is in a weak group, especially when the overall market is negative. Chart 7-9 of Aluminum Company of America looked weak when the stock broke below the M at 36 in early 1973, point A. Later that year, when it again broke below the M at a much higher level, 47 point B, it looked even more vulnerable. In both cases, you should have passed on it and looked elsewhere for your bear market action, because chart 7-10 of the aluminum group was showing far too much strength as the relative strength continued to trend higher. On the other hand, it's not at all surprising that PSA chart 7-11 crashed and turned out to be a great short sale, as the airline group chart 7-12 was in trouble right along with the individual stock. The final error to be on guard against is that of selling short without placing a protective buy stop. Never do this. If your short sale is on the New York or American exchange, then physically place the protective buy stop for order on a good till canceled basis. But if it's over the counter, make sure your broker has it on his market monitor and will immediately cover it for you if it hits your buy stop level. Summary of short selling don'ts. Don't sell short because the P/E is too high. Don't sell short because the stock has run up too much. Don't sell short a sucker stock that everyone else agrees must crash. Don't sell short a stock that trades thinly. Don't sell short a stage 2 stock. Don't sell short a stock in a strong group. Don't sell short without protecting yourself with a buy stop order. How to do it right. Now that we know what not to do, let's start learning how to sell short successfully in a disciplined and unemotional manner. The starting point is to look for a stock that has had a substantial advance over the past year. However, don't stop there, as so many amateurs do. It is important that you make sure your short sale candidate is in stage 3 with a flat MA, or, even better, an EMA that is starting to decline. Also look for a stock that has trended sideways for several weeks. Moving sideways is a sign that a distributional top formation is unfolding that will help power your stock on the downside. Finally, look for a clear-cut level at or preferably below the M that will signal the start of a stage 4 downtrend if it's violated. Chart 7-13 illustrates this point. As long as XYZ was trending higher and the EMA was rising, you shouldn't have even considered shorting the stock. But after the EMA leveled out and a top was completed, point A, the probabilities of a major decline became high. When to sell short? The next question to resolve is, when is the best time to initiate your short sale? Is it when the initial breakdown occurs, point A, or when the pullback rally takes the stock back toward the breakdown area, point B? Again, everything that we learned on the buy side is valid when we're shorting. We just have to reverse the steps. I said earlier that when dealing with upside breakouts, the risk is lower if you buy on pullbacks, but there is always the chance that you'll miss out entirely and never buy the stock if it doesn't pull back. I therefore stress that the best tactic for investors is to buy half the position on a breakout and the other half on a pullback toward the breakout point. Traders, on the other hand, should go for it and buy their entire position on the breakout. The rules for short selling are the same. Traders should sell short their entire proposed position on the breakdown. This is especially important for traders to realize. While pullbacks toward the breakdown level do occur in better than half the cases, they nevertheless occur far less frequently than pullbacks toward breakout points. The reason is simple. Stocks decline because of fear, and when panic gets out of hand, it's simply a matter of bombs away. Nevertheless, conservative investors who want to keep their risk to a minimum should sell short only one half of the proposed position on the initial breakdown, and then short the other half on a pullback. Chart 714 of General Medical, a short sale recommendation in the professional tape reader back in 1973, illustrates what I'm talking about. As long as the stock remained in stage 2, we refused to join the crowd and call it overvalued even though its P/E was a ridiculous 47. But once the EMA stopped rising and a top formed, it was time to put it on our short-selling shopping list. Then after it broke down at point A, the fun began as it plummeted lower and lower, taking some profitable steps. Just as there is a disciplined sequence that you should use when considering buying, so too, there is one for short selling. 1. The market. The very important starting point is the overall market trend. While I'm not going to tell you that you can never sell a stock short when the major market trend is bullish, this should be the exception, certainly not the rule. Just as I showed you back in Chapter 5, how an outstandingly bullish chart pattern such as National Semiconductor could have been bought in the 1973 bear market. So too, an outstandingly bearish chart pattern can be sold short even when the overall market trend is favorable. Buying National Semiconductor in a bear market should have been done as a hedge against the many short sales you had outstanding. By the same token, if you find an outstandingly negative chart pattern, that one stock should be a hedge against your many longs. In general, however, it's best to keep it simple. When the market's major trend is bullish, you want to look for buys. And conversely, when the investment climate is clearly negative, you want to look for short sales. The starting point will be market averages that are clearly negative, as they were in 1962, 1966, 1973-74, 1977, and 1981-82. Then you want to do aggressive short selling. Once the major trend turns clearly bearish, as it did in early 1973, see Chart 715. It becomes easy to rack up big profits on the short side. So once we are sure that all of the market averages are below the 30-week EMAs and are in stage 4, and the majority of our other long-term gauges, which I will teach you in Chapter 8, are also negative, it's time to start hunting for some good short sale candidates. 2. The group. The next step is to isolate those market sectors that are showing significant potential vulnerability. To do this, we look at the group charts for negative formations. We want to make sure the group has broken below its 30-week EMA. Another key is that the relative strength line is trending lower. Finally, it's important that several charts from that sector are acting technically weak. As charts 716 and 717 show, the really major scores on the downside come from the 1-2 punch of a bearish market group and individual stock chart from that sector. It is no coincidence that Coleco, which was a PTR short sale recommendation in early 1973, turned into a huge winner on the downside. This stock had everything going for it. The overall market trend was bearish, the group was negative, and Coleco's chart pattern was horrid once it broke down and completed its head and shoulder top formation. Later in this chapter, I'll cover this very important and profitable formation in great detail. 3. The individual chart pattern. Now let's refine the process further. There are several factors that go into making up an ideal short sale candidate. We don't want just an okay short that is going to go down. We want A+ shorts. Here are the filters that will help you separate the champs from the chumps. Make sure the stock has had a significant run up before the top has formed. If the top unfolds after a mediocre stage 2 advance, it's very likely to have a minor drop that will just take it back into its prior base area, which won't be a thrilling ride. But if your short sale candidate has taken off like a rocket before the stage 3 top forms, the probabilities are very strong that a big downhill slide is in store. The second factor requiring strict attention is whether or not there is a significant area of support close to the breakdown point. Here are two charts that both formed stage 3 tops and then broke down into stage 4. Chart 718 of Northwest Airlines had only a so-so decline because there was solid support near 22, which wasn't far below the breakdown at 26.875, point A. Not surprisingly, the decline halted as NWA neared 22. On the other hand, Chart 719 of Hiram Walker had no further nearby support once it broke 20.A, and like Humpty Dumpty, it suffered a great fall. 4. Relative strength. Never sell a stock short that has very positive relative strength RS, especially if the RS line is trending higher. If such a stock breaks down and you own it, of course you'll sell it, but you do not want to sell that stock short. While it's okay if the relative strength is above the zero line on the Mansfield chart, it must have clearly topped out and started trending lower. It is even more negative if a breakdown on the price chart is accompanied by a drop into negative territory by the RS line. These stocks are the short sales that usually turn out to be the A-plus winners. Chart 720 of U.S. Steel in 1974 is a perfect example of a stock with strong relative strength that should not have been shorted even when it violated support at 42.A. When it broke down, the RS line was still very healthy. Therefore, the stock did not turn out to be a profitable short sale. At the same time, Chart 721 of Allen was an excellent stock to sell short late in 1972. Its relative strength weakened badly and pierced the zero line as the stock dropped below support at 19.A. One glance at the chart shows what happened once Stage 4 appeared in all its glory. 5. Volume. Now, pay careful attention. Volume is crucial when we're dealing with upside breakouts on the buy side. You should never buy a breakout that does not have confirming volume. If you do buy one and volume doesn't confirm, then you should sell it on the first minor advance. The short side is 100% different. While it's nice if volume does pick up significantly and confirm the downside breakout, volume is not a necessary ingredient for a winning short sale. It takes power to make a stock rise, but a stock can truly fall of its own weight. There are many cases, such as Jonathan Logan Jall back in 1973, where volume did not confirm the downside breakout, and the stocks turn out to be spectacular winners. Jall Chart 722 completed a major top when it broke below its trend line at 55.A. Note how low volume was at that point B. This didn't stop the stock from tumbling close to 90%. It's even more negative if volume increases on the breakdown and then contracts on the pullback toward the breakdown area. You don't need to make volume a major priority when you're looking for potential winners on the short side, while you most definitely do under the rules for buying. 6. Support. The last factor to check out is how much nearby support is beneath the stock. The ideal short sale is one that has had a steep Stage 2 advance with only small congestion areas along the way. This situation will slip rapidly when the retro rockets are fired. On the other hand, a stock that has risen slowly and has a large trading zone not too far below the breakdown level will be far more resistant to decline. Chart 723 of Pacific Scientific and 724 of Bank One illustrate this point. Pacific had a straight-up Stage 2 advance with no significant congestion areas of support along the way. Not surprisingly, there was symmetry on the downside as it fell even faster than it rose. Chart 724 of Bank One Corporation presents us with a very different pattern and result. First, the advance was slower and far less exciting. In addition, it traded for quite some time in the 20 to 24 zone before breaking out and moving above 28. When Bank One broke both its 30-week EMA and trend line point A, the decline was very slow. It also failed to break below the major support at 20 despite several attempts. So always favor a chart that has minimal support below it when narrowing down your shorting candidates. Placing the order. Once you determine the one or two stocks that you want to sell short, here's how your order should be placed. If stock XYZ breaks down at 24.875, put in an order to sell short the desired amount of shares with a 24.875 stop and a limit of 24.375. Here is another difference from the buy side. On the buy side, in actively traded issues, we said to only make the spread between the stop and limit price 0.25 of a point. When you are shorting, however, you should make it at least 0.50 point and, in inactive cases, a bit more. Here's why. There's an archaic rule on both the New York and American stock exchanges called the uptick rule. It states that you can only sell a stock short after it trades at a higher price. In my opinion, this is a ridiculous lack of logic which grew out of the 1929 crash. To prevent so-called bear raids, the exchanges in their infinite wisdom decided they would not let stocks be sold down too sharply by short sellers. This shows a tremendous prejudice for bull markets on the part of the exchanges. Can you really imagine them telling you that you can only buy a stock if it downticks? That's nonsense, and someday, I believe the uptick rule will go the way of weekend trading. Due to the uptick rule, you want to give yourself a bit more leeway to get your short sale off. As on the buy side, your order should be entered on a good till canceled basis. With over-the-counter stocks, you must depend on your broker since you cannot physically place stop orders. The advantage is that there is no nonsensical uptick rule over the counter. Therefore, if you see XYZ breaking below 25 bid, and 24.875 is the point at which you should sell it short, as soon as the bid goes to 24.875, your broker can immediately sell it short for you. That really is quite a big plus in a crashing market. Never too late. Thus far, we've discussed short selling near the breakdown point. But is shorting feasible when a stock has already had a substantial decline? The answer is an emphatic yes. While it would be more ideal to go short near the top because the profit potential is larger, remember that the really big losers have a habit of becoming even bigger busts before they hit rock bottom. Shorting well into a stage 4 decline is a good trader's tactic because the sell-offs that immediately follow are usually fast and furious. But this tactic is only to be used if a consolidation pattern forms beneath the declining M, and then a new breakdown occurs. This type of trading is comparable to continuation buying in stage 2. Just as continuation buys are more for traders, this formation is more for an aggressive market player and trader. But such a short does have its merits since the decline can be very rapid when it makes the renewed breakdown. Shorting a stock like Winnebago chart 725, which had already dropped from close to 50 to 22 after it consolidated and then broke down again at 21.875. Made a lot of sense, as it produced an additional super gain in a hurry. Good candidates for this type of shorting are stocks that are part of a group which has fallen completely out of favor. It's even better if you find one such as Winnebago back in 1973 that had a fancy institutional following. When the institution's love turns to loathing, it's a safe bet there will be a long downward trail of panic selling. Despite an already steep price fall, the downside percentage potential can still be considerable. 22-3, as in the case of Winnebago, is a tremendous percentage drop irrespective of the large prior decline. Just make sure that you don't short such a stock without the proper pattern first forming. Be sure a consolidation has taken place and a new breakdown occurs. You must choose a proper entry point so there will be plenty of resistance and a sound place to enter a protective buy stop overhead. Especially profitable formations. Back in Chapter 4, I showed you the importance of spotting head and shoulder bottom formations since they lead to incredibly profitable upside advances. The converse is also true. Head and shoulder top formations, especially when they come after a dynamic advance, are among the most profitable short selling signals. While they don't occur with great frequency, they do form more often than head and shoulder bottom patterns, and they do appear often enough to be a source of great gain. In fact, when you start to see a bevy of these formations occurring, it's a signal that a major market top is moving into place. The first ingredient of a valid head and shoulder top pattern is a stock which has been very strong and already had a substantial advance. The beauty of this formation is its ability to spot trend reversals. If there's no big prior up move to reverse, forget it. It's not going to be exciting. Volume should be well above average on the advance as the late comers rush in close to the end of the move. Then along comes a correction as profit taking sets in BC on chart 726. Once the sell-off runs its course point C, the stock then shoots ahead to another new high point D. No problem yet, except that on this second rally, volume usually stops expanding and is often less than on the preceding rise. This is the first sign of potential trouble. The dwindling volume reflects lessened buying interest at this lofty level. A second correction, DE, then quickly sets in. This is another sign that something is starting to go wrong. After breaking to a new high point D, the stock appears to be embarking on a new up leg as the buyer's greed glands start to work overtime. Instead, the stock only moves ahead a few points and then quickly sells off once again. The clincher that tells you weakness is setting in is how far back this second decline DE carries. As I've shown you before, when dealing with support areas, the former peak B should act as support when the stock starts to decline. The fact that the decline instead carries the stock all the way to the prior low C is a distinct negative. Now you have a potential left shoulder, a BC, and head CDA, as well as a trendline CE connecting the two correction lows. This trendline is the potential neckline of the head and shoulder top formation and must be watched very carefully. If it breaks, watch out. Now it all hinges on the next rally. Will the upward momentum reassert itself, or is the stock getting too tired and sellers increasingly anxious? Whatever you do, don't jump the gun. Don't anticipate that most of the pieces of the puzzle are in place for a short sale. In about 1/3 of the cases, these potential top formations will not move to completion and will instead end up breaking out on the upside. If, as in the case of chart 726, the next rally, EF, fails to exceed the previous rally peak D, or even worse, ends its advance at the same point as the left shoulder peak B, then look out. If it drops back toward the neckline once again, you have a clearly recognizable right shoulder. Volume will usually be lighter on the right shoulder. While it isn't crucial that volume is heaviest on the left shoulder or the head, don't trust the formation if the heaviest volume appears on the right shoulder. If that much buying power is still present, there is a high probability that the formation will prove a short seller's trap. So look elsewhere. Finally, the next decline, FG, takes the stock below the neckline. At this point, the potential head and shoulder top becomes a reality. This is the most bearish pattern that can form, so if you ever find yourself holding a stock that has just completed one, don't hope and pray sell it immediately. And if conditions are right, overall market trend and group are negative, go for it and sell the stock short. There are a few other subtleties that you should be aware of. The first can easily be summed up in a rhyme that I've used for years: the bigger the top, the bigger the drop. The longer this bearish formation takes to form, the more powerful the eventual down move will be. While all head and shoulder top patterns are negative, one that forms in 3 weeks isn't as powerful as one that unfolds over a 9-month span. This makes sense because the more time the stock spends forming the pattern, the more buyers who are trapped in that top area. And it's those late for the party buyers who will supply the downside fireworks when they begin to panic many points lower. A second factor to remember is that the wider the swing from the neckline to the peak, the more vulnerable the pattern is. The reason for this is that the more volatile the stock is when the top forms, the greater the risk buyers are willing to take in that high-risk zone. They really had to believe the fundamental story or rumor to buy in the face of such wild swings. That great confidence turns to great disappointment and panic when the bearish reality sets in. Now let's look at some actual case histories of head and shoulder top patterns as theory merges with reality. First, go back and look at charts 7.1, 7.14, and 7.16. Teleprompter, General Medical, and Calico were all PTR short sale recommendations that formed head and shoulder tops before moving into stage 4. Metro Media, chart 7.27, is another classic example of the power of this bearish pattern. Volume was very low on the right shoulder rally, and the group was also weakening. Metro Media did tease a bit, breaking below the neckline a few times before declining. At no point, however, did it give you a reason to get out, as the EMA continued to decline, and the stock did not move significantly above it at any time. Later in this chapter, I'll show you where your protective buy stop should be placed and how to lower it to lock in more and more of your profits as the stock plummets. Once Metro Media developed downside momentum, it became a dream short. It crumbled from its break of the neckline at 31.875 down close to 5. Farah, chart 728, was another excellent short back in 1972 after it, too, completed a head and shoulder top. Breaking below its neckline at 33, it had dropped close to 10 in 1 year as stage 4 ran its downward course. Diamond Bathurst, chart 729, really demonstrates just how powerful this pattern can be. In 1986, in the midst of one of history's great bull markets, DBH formed a head and shoulder top over a 9-month period. When it broke below its neckline at 24, it dropped an incredible 55% in the next 3 months. Always be on the lookout for these formations, as they are both potent and profitable. Finally, if you see them forming on page after page of your chart book, as was the case in the late 1972, early 1973 period, it's an important indicator for the overall market. Very simply, it's a clear-cut sign to change your thinking from long to short. Projecting a target. In a few pages, I'll show you how to use buy stops to lock in your gains on short sales, but there is one more profitable technique I want to share with you first. Back in Chapter 6, I showed you how to use the swing rule to make uncannily accurate projections on the buy side. That same principle applies on the downside too. Using chart 730 as a model, take the low price that a stock hits point A, while it is in a top area, and subtract it from the highest level that the stock reaches thereafter, point B, before it breaks below the prior low, A. Since the stock peaked at 60, point B, and the prior low, point A, was at 40, you get a difference of 20 points, 60 minus 40. The next step is to subtract that 20 points from the old low point A. 40 minus 20 points equals 20. This level then becomes a potential trading target. Just as on the long side, this measurement is usually quite accurate, and it pays to be alert for signs of a trading bottom forming near there. Hughes' tool dropped to a low of 30.A in chart 731 in late 1981. It then rallied back up to 45.B. That measurement equals 15 points. 45 minus 30 equals 15. Therefore, once Hughes' tool violated support at 30, the swing rule projected a downside target of 15. A few months later, HT hit 14.375.C, which turned out to be the low of the year for 1982. Mermont chart 732 underwent a really wild sequence, as it first dropped close to 31.A before rallying sharply to a peak reading of 59.50.B. This was a very unusual wide swing that predicted a devastating fall if Mermont broke below point A. After all, 59.50 minus 31 equals 28.50 points. Subtracting that 28.50 points from the point A bottom at 31 yields what appears to be a ridiculous reading of a drop to 2.50. Once Mermont did break below point A, it bottomed at 6, not far above the swing rule target level. The same technique can be applied to moves in the overall market averages. Projecting a bottom for the 1981 to 1982 bear market was as easy as A, B, C chart 733. At point A, the Dow Jones Industrial Average dropped to a low of 894. In the spring of 1981, the Dow had an intraday high point B of 1,031. That yields a difference of 137 points. Later in the year, when the DJI violated its low at point A, a downside projection of 757 was flashed. As hard as it is to believe, when the Dow ultimately bottomed and ended that bear market, the low in August of 1982 was 770. Therefore, when you're trading a stock on the short side, the downside swing rule gives you an excellent tool. Once the stock drops down close to its target area, take your profit on half the position and play the remainder using a protective buy stop. Protecting your short with a buy stop. By now, you should have a pretty good idea of what I'm going to say next. There are no big surprises. It's merely a matter of adapting the buy stop concept that I taught you in Chapter 3 to the short side. If you reverse everything that we went over in Chapter 6 about sell stops, you should already know what to do. I'll run through one ideal example and a few case histories to make sure you have it down pat. To me, this is one of the real keys to profitable short selling. First, it will give you peace of mind when shorting. Don't underestimate the importance of mental calm. Your emotions can end up overwhelming your chart reading ability time and time again if you get nervous about market action. Second, this discipline will make sure any loss is relatively small if the short sale position moves against you. Finally, once your stock starts crashing, it will guarantee that your profits increase as you move further and further into stage 4. Before going further, promise yourself that you will absolutely never go short without first placing a protective buy stop on a good till canceled basis with your broker. Just as on the long side, calculate where the buy stop should be placed before you dial your broker. A very important part of the process for picking a good short sale candidate is being able to protect it with a buy stop that is not too far from the ideal short selling price. This negates the old short selling bug, a boo that the stock can run to infinity. If your short sale fulfills all the other criteria, but the protective buy stop must be placed 30 to 40% from the point of short sale, look for another stock. In the same manner, if you come across two potential short sales that look equally vulnerable and fulfill all of the other criteria, but one can be protected with a 10% buy stop, while the second one has its buy stop 20% from the shorting level, then go with the lower risk candidate. After you sell your stock short and place the protective buy stop, it's very important to know how to methodically lower the stop in the following weeks to lock in more and more of the gain. Let's go through the process carefully. Prior rally peaks and the 30-week EMA will be the two key factors you will focus on when setting your protective buy stops. When you set the initial buy stop, pay less attention to the EMA and more to the prior peak. For example, in chart 734 you'll note that after a very sharp stage 2 advance, stock XYZ formed a stage 3 top as it trended sideways in the 60 to 70 zone. It eventually violated support at 60.C and broke below the 30-week MA, which had flattened out. This was a stage 4 sell signal, and the point to sell the stock short was at 59.875. The initial buy stop should have been placed right above the prior rally high point B of 65. Therefore, the good till cancelled buy stop would be placed at 65.125. If, however, the prior peak had been 64.625 or 64.75, you would still place the buy stop at 65.125. It's the same concept, but in reverse, that I told you about when placing sell stops. Like buyers, sellers are affected by round number psychology. A heavy batch of sell orders are likely to accumulate at 65 instead of 64.875 or 64.75. Therefore, always place the buy stop above the round number whenever it's close to it. The next step is to relax and let the market action unfold. In the unlikely event that your short sale moves against you, your protective buy stop will keep your loss to a minimum and you will be able to make it up on a future trade. More likely, however, the stock will start tumbling and the profits will build up. Here's how to keep those profits from evaporating. As long as your short sale is below its declining 30-week MA, give it plenty of room to swing. Trail the buy stop behind the declining price in the following manner. After the first sell-off that bottoms at point D, and then the first significant oversold rally of at least 8%, get set to lower the protective buy stop. Don't actually alter the buy stop until after the rally reaches its peak, point E, and then moves back toward its prior low, point D. If a move above that rally peak at E also takes the stock above the 30-week MA, then an investor lowers the buy stop to a point right above that level. But if, as in this example, the peak falls short of the MA, an investor should still place the buy stop above the MA point F. Later in the cycle, when the EMA levels out, become more aggressive and press the buy stop to a tighter position right above the rally peak. Next, the stock drops sharply to point G, which is normal stage 4 behavior. After rallying sharply back toward the declining MA point H, the rally fails and the stock starts heading south once again. Don't worry if the stock nudges slightly above the declining MA. It's only a cause for concern if it moves significantly above it. After the rally terminates and the stock drops back toward the prior low, point G, then the buy stop should be lowered right above the round number of the prior rally peak at point H. In the following months, the protective buy stop should be lowered sequentially to points J, K, L, and M before the position is eventually stopped out at 25.125 for a substantial profit. Note that the tactics change slightly once you've reached a stage 1 base area and the EMA is no longer declining. The protective buy stop is lowered to point M above the significant area of resistance, even though this buy stop point is below the 30-week MA. Now let's look at some actual case histories so you can get some practice at placing buy stops. Blair chart 735 completed a small head and shoulder top formation in mid-1972, then broke below its neckline at point A, where the stock should have been sold short at 19.875. The initial protective buy stop should have been placed right above the rally peak at point B. Then, as stage 4 started dropping the stock lower and lower, the protective buy stop should have been lowered to points C, D, E, and so forth, all the way down to point K, near 7.50. When Blair moved above 7.50 and your protective buy stop was hit, an excellent profit was locked in even though that did not turn out to be the absolute low point. That's fine, because our method locked in better than a 60% gain in a disciplined, unemotional manner and took us out of the short sale position very close to the low. The same winning tactic is illustrated very nicely by Dow Chemical chart 736, which suffered severely during the 1977 bear market. Dow completed a stage 3 top formation and moved into stage 4 once it broke below both support and its 30-week EMA at point A, near 53. Initially, the position should have been protected with a close protective buy stop set at point B right above the prior rally peak. In the following months, the buy stop should have been lowered to points C, D, E, and so on, until it was finally lowered to point M at 25.125, where the position was closed out for a fabulous profit. Note that if you didn't have this discipline working for you, you would have started giving back a good portion of your excellent gain, as the stock worked its way back toward the mid-30s in the following months. Instead of being in that frustrating would-have, could-have, should-have position, our system of buy stops got us out within 3 points of the bottom and allowed us to remain relaxed and in control of the situation throughout the entire decline. Even though the market will definitely throw some frustrating curves at you along the way, this is the disciplined, unemotional, and profitable way to go. Always protect all your positions, both shorts and longs, with stops. Remain entirely mechanical no matter what headlines or TV news flashes you see. Using buy stops, the trader's way. The rules for traders' buy stops are just the reverse of the long side sell stops. As on the long side, traders must be more aggressive than investors in their use of stops. An investor wants to give a short sale plenty of room for gyrations as long as it doesn't ruin the overall negative pattern. A trader only wants to stay with the position as long as it closely follows the game plan. As soon as the position begins to deviate, it's time to get out and look for a new short position. The trader must look at gyrations as either potential reversals or possibly the beginnings of sideways trading zones that will tie up his capital for long periods. Just as on the long side, a trader shouldn't wait for the 30-week EMA to be violated on a rally before covering a short sale. Chart 737 shows you just how the trading game should be played on the short side. First of all, stock XYZ moves in a sideways stage 3 pattern between support near 60 and resistance near 70. Eventually, it breaks below significant support at 60, flashing a sell signal at 59.875, point A. That's where the stock should be shorted. In this case, the initial buy stop should not be handled in the same manner as for the investor. Just as on the long side, it's imperative that traders keep their losses to a minimum, so the protective buy stop should be set in the following manner. If there is a prior peak very close to the breakdown level, use that as the point to set your buy stop. If, however, there is no close stop, and you have to set your initial buy stop 10 to 15% above the short sale price, place the buy stop 4 to 6% point B above the breakdown level point A. Make sure it's above a round number. For instance, if the breakdown is at 59.875, 5% would be 62.875. Therefore, place it above the round number of 63 at 63.125. In the following weeks, XYZ dropped to point C before undergoing the expected pullback rally toward the initial breakdown. Once the rally failed at point D, and the stock dropped back to the prior low at C and broke below that point, the trading buy stop should have been lowered to point D. Thereafter, the stock dropped quickly to point E before staging a new rally that failed at point F. Then, when a new decline dropped XYZ back to point E and broke below it, the buy stop should have been lowered to point F, and in the same manner to point H and then J. Eventually, a double bottom formed and the stop at J of 36.125 was set off, locking in a fine trading profit. Never forget, place the buy stops right above the round numbers when you are close to them. For instance, if the rally at J had terminated at 35.75, the buy stop should have been set at 36.125. One last important point, as on the long side, don't pay attention to oversold rallies that don't advance at least 7% or more. Investors should use an 8 to 10% threshold. The wiggles and jiggles that take place in the 3 to 4% range are just that, wiggles rather than meaningful moves that should determine strategy. And one final tip, which by now should certainly not surprise you, traders should never stay with a short position that moves above its 30-week EMA, even momentarily. Chart 738 of Seaboard World shows how traders should use buy stops in the real world. Seaboard completed a major head and shoulder top formation when it broke below the neckline at 10.875. The initial trading buy stop should have been placed about 6% above the 10.75 entry price. 6% of 10.75 yields a price of 11.375. Therefore, the buy stop should have been placed above the round number, under 20, each 0.50 point counts as a round number, of 11.50, at 11.625 point B. In the succeeding months, the stop should have been dropped to points C, D, E, F, and finally G at 0.25. After dropping to a low near 4, Seaboard nudged above the MA and above point G. Traders would be stopped out at 5.25 for an excellent profit. As a trader, you should not have been at all concerned that the stock subsequently broke to yet another new low before bouncing back up. A big profit was scored in a hurry in a disciplined manner. As Bernard Baruch commented about how he had become so wealthy, "I always made the mistake of getting out too early." Trend lines on the downside. The last technique that traders must add to their arsenal of profitable methods is the use of trend lines when selling short. The same concept that I showed you in Chapter 6 of using trading trend lines on the long side is valid when selling short, however, in reverse. If no valid trend line forms one that hits at least 3 points, then simply use the trading buy-stop technique. When a clear-cut trend line does form, it certainly pays to utilize it. At least a portion of the short position should be covered when such a trend line is violated. The remainder can be protected with a buy-stop, which will usually be at a somewhat higher price than the trend line. Chart 739 illustrates how to add trend lines to your bear market game plan. Initially, the buy stop should be set at 53.125 point A. Take 6% of 49.875, which equals 52.875, and place the buy stop above the round number 53.125. As the stock starts doing its stage 4 thing, the buy stop should be lowered, first to point C, then to point D. After that, the strategy changes. Rally peaks B, C, and D form a valid down-sloping trend line. You should recognize this and incorporate it into your strategy. In the following weeks, as XYZ goes into free fall, you should lower your buy stop to points E, F, G, and so forth on half the position, using the trend line as a guide. Since it is angling downward, you can continue lowering the buy stop on this half position even if the stock moves sideways, as it did following point K. Half the position is now protected with a buy stop above H, and half is set very tightly at point J. Eventually, the sideways action nudges the stock above the trend line, and the buy stop at J is set off for an excellent profit. Even if the penetration of the trend line doesn't indicate a sharp upside reversal, it is likely to lead to a neutral trading range. This is a great time for traders to do at least partial profit taking. When real strength appears and the second buy stop point H is hit, another excellent gain is locked in, and the position becomes history. Chart 740 of Peabody Galleon points out the advantages of using trend lines. Peabody should have been sold short when it broke below its upsloping trend line, A to B. The initial buy stop should have been placed above the round number of 41 point D. After the sharp sell-off toward the 26 area and the rally back to 34 point E, another wave of selling set in. At first, the buy stop should have been lowered to E. But by then, a clear-cut trend line formed that was touched more than 3 times, and the buy stop should have then been lowered to points F, G, and H in the following weeks. Finally, after an exciting downward ride, Peabody moved above its down-sloping trend line at point H, rallying above 22. An excellent profit was thus established on half the position. When Peabody demonstrated enough strength to go above its EMA near 26, it was time to clear out of the remainder of the position with another fine trading profit. Interestingly, although that first sell-off low did not turn out to be the absolute low for the 1973-1974 bear market, PBD was still very close to that level a year later. Once again, the trader's purpose was well served, as the trend line kept them in for the sharp downside smash and then helped them exit before the choppy sideways action. Always be alert to these important trend lines. They can make short selling both fun and highly profitable. Another way: 0F reducing risk. The use of put options is yet another way to play the downside with relatively little risk. By buying a put, you have the right to deliver that stock at a specified price until a given date. Thus, if you buy a put on XYZ at 50 for a price of $250, and XYZ then falls to 30 before the expiration date of the option, you're in great shape. You can buy the shares in the open market at 30 and deliver them to the original seller of the put at 50. The 20-point difference minus the cost of the put is your profit in this case, $1,750 excluding commissions. Buying a put on a stock you think is going to collapse gives you the same rooting interest as going short. The advantage is that the most you can lose is the price of the put in this case, $250. On the negative side, the premium you pay for the put does cut into your profit potential, and if the move doesn't develop before your option expires, you're out the cost of the option. For the average market player, short selling is the preferable tactic. For seasoned speculators, put buying can be a fine way of limiting risk while also increasing your leverage. In Chapter 9, we'll go into options in greater detail. In conclusion, you should understand that Stage 4 situations actually offer you another opportunity to make money, and there is no more risk to selling short than to buying as long as you follow my few important guidelines and always use protective buy stops. Chapter 8. Using the best long-term indicators to spot bull and bear markets. Wouldn't it be great to have bought aggressively in January 1975, March 1978, and August 1982? Each of those junctures occurred right before major bull markets were about to get underway. And it would have been even nicer to have moved to a very defensive position in January 1973, late 1976, July 1981, and early October 1987, before major bear markets took their toll. The professional tape reader did, and you can too. In July of 1982, many economists were writing about a severe recession that would last for another year or more. With the Dow Jones Industrial Average, JI, below 800, a widely followed market guru was predicting a crash to at least 500, and the public was listening and believing. After having been bearish for the prior 12 months, I wrote in the July 22, 1982, issue of PTR, "We are in the embryonic stages of a new bull market. And for the first time since we turned bearish at the June 1981 top, we now want you to use all dips for buying." 3 weeks later, the market touched its intraday low at 770, and the rest was history. One of the greatest bull markets in this century was launched. At the other extreme, the public was absolutely euphoric in August of 1987. One leading financial magazine even wrote an article with the overly optimistic title, "Dow 3000, not if, but when." The super bulls were tripping all over themselves to come up with higher and higher market projections. Dow 3500 was considered a sure thing, and 4000 was seen as reasonable because our prices were so much cheaper than those of the Japanese market. In this wildly bullish environment, I sounded like a real party pooper when I wrote in the September 17, 1987, issue of PTR, just days after the all-time high of 2746, that there are some ominous clouds forming on the horizon. In the following weeks, my technical indicators became more and more negative, and I had subscribers build up substantial cash reserves. Then, on October 15th, I wrote that this is most definitely not a time to abandon a defensive posture. That following Monday, October 19th, saw the worst one-day crash in history as the Dow dropped an incredible 508 points. How did I do it? Simply by doing my technical homework and listening to the message of my long-term indicators. After you study this chapter, you too will be able to confidently spot major top and bottom areas with precision. I keep tabs on well over 100 technical indicators and report on the 50 best gauges in every issue of PTR. These 50 indicators comprise my weight of the evidence, which is how I judge the technical health of the market's three trends: long, intermediate, and short-term. My method differs from that of many other analysts who track a few gauges in which they have faith. The reason I favor my broad-based approach is because, over the years, I've learned that any technical tool, no matter how good its record, will throw you a curve at some point. If you lean too heavily on just a few indicators, your system will sooner or later take you out into left field. If you learn to listen to the collective message of the majority of these fine gauges, your probabilities of ending up on the wrong wavelength are quite small. While it's always important to keep in touch with the major trend, it's absolutely vital when the market moves into a high-risk zone, such as late 1972 and early October 1987, or a low-risk area, such as early 1975 and the summer of 1982. These are the times when false signals and whipsaws are most likely to pop up on your individual stock charts. By identifying when you are entering a high-risk area, you can build up large cash reserves and become extremely selective in your purchases. In addition, you can test the waters with a short sale or two. On the other hand, when our trusted indicators point out that the market is entering a low-risk zone at the end of a bear market, it makes sense to start locking in profits on short sales, building up cash reserves, and getting ready to start doing selective buying. At other times when everything is strongly bullish, such as August 1982 to June 1983, or clearly negative, such as January 1973 to October 1974, you should move aggressively with the trend. It's therefore very important that you are always aware of the technical health, or lack thereof, of the market's major trend. I spent a lot of time reflecting before writing this chapter because I wanted to find the perfect middle ground approach for you. Obviously, I'd like you to keep in touch with all 50 of my excellent technical gauges so you are very sharp when dealing with all the curveballs the market can throw at you. At the same time, I know you don't have the time and staff that I do to keep up so many indicators. So I carefully researched all of my technical tools and came up with those few that you need to follow to stay finely tuned to the major trend. These gauges are easy to keep up, and if you had listened to their majority opinion, you would have identified every bull and bear market over the past several decades. Stage analysis for the market averages. The starting point is obvious. By now, you should certainly feel very comfortable with stage analysis, so let's apply it to the market averages. This is one of the easiest gauges to keep up and yet is the most important one. You have no choice with this one. If you keep up just one long-term indicator, this is it. Track it in a weekly chart service or plot it yourself. If you decide to keep up this indicator yourself, refer to page 313 in Chapter 9, which deals with calculating a moving average MA. Every Friday, plot the closing price and write it on a data sheet. Then calculate and keep up a 30-week MA of that data. Next, interpret the action. Just as with stage analysis for individual stocks, once a potential stage 3 top forms on the GIA, you must proceed with caution. Then, when the Dow breaks below its 30-week MA and breaks down into stage 4, it's time to become very defensive. Suspend buying even if you see a few stocks breaking out on their charts. Be sure to sell any stocks that are showing poor relative strength. Pull up your protective sell stops as tightly as possible on your few remaining long positions. Finally, start hunting for ideal short sale patterns. While this key long-term indicator certainly isn't infallible and will give an occasional whipsaw signal, it is incredibly reliable. A bear market in the past several decades has unfolded without this gauge flashing a negative signal. Study Chart 8.1, and you'll see one of the main reasons I turned bearish before the October 1987 crash. After moving above its 30-week MA in August 1984, and then moving into Stage 2 in early 1985, the DJI had a real moon shot on the upside. For the next 2.5 years it was up, and away as the average more than doubled while remaining above its rising 30-week MA. But in late 1987, some dangerous things began to happen. First, the average moved to a new high in late August point A before selling off sharply to point B. This was followed by another rally in early October point C that failed to reach the August peak. This A, B, C sequence had an obvious toppy potential to it. When the DJI later broke below the prior low at point B, at least an intermediate term top was signaled. While these negative zigzags were taking place, an even more serious problem was taking shape. The 30-week MA was losing upside momentum and starting to level out. This gave the chart a worrisome Stage 3 appearance. The last strike was thrown at the market when it finally broke below the 30-week MA near 2450. This was a strong stage for sell signal and a sign that the party was over. A new bear market was beginning. Within the next few sessions, the market started to accelerate on the downside, suffering its greatest one-day percentage drop in history. While many others exclaimed that the crash came out of the blue, you now know differently. It was exactly the same in 1929. Many words have been written about that long-ago debacle, but few are true. I've seen some authors assert that the only way to have avoided the 1929 disaster was to have exited the market as early as 1928, when stocks started becoming really overvalued. Others have said that crash also was totally unpredictable. Nonsense. History and cycles truly do repeat themselves, and as the phrase goes, those who fail to learn from history are doomed to repeat it. You didn't have to say goodbye to stocks in either 1928 or 1986, when they became fundamentally overvalued. If you had, you would have missed out on 2 fabulous rallies. In both cases, simply spotting the Stage 3 potential tops and then reacting to the Stage 4 breakdowns of the 30-week MA would have put you far ahead of the Wall Street crowd, see Chart 8.2 of 1929 crash, while letting you stay safely in the game until the final inning. Now study Chart 8.3, which shows the Stage 3 tops and eventual breakdowns into Stage 4 of the DJI for several bear markets. In every case, the story was the same. Once a Stage 3 top formed and the MA stopped rising, it was time to be careful. The final negative signal was a significant break below the 30-week MA. Thereafter, once the MA started heading south, you should have remained in your bear market storm shelter until the MA showed signs of leveling out. Remember, it's not enough for the industrials to temporarily pop above the MA, as in late 1969. if the average continues pointing lower. On the other hand, this important long-term indicator is not a Johnny-one-note type of gauge. Unlike many others that I've researched over the years, stage analysis is equally adept at spotting the start of bull and bear markets. After a major decline, once a stage 1 base starts to form, it's time to get set for the next bull market signal. See Chart 8.4. Once the level 30-week MA is penetrated on the upside, it's time to look aggressively for buys on your stock charts. The advanced decline line. The next important market indicator to track closely is the New York Stock Exchange, NYSE, advanced decline line. An AD line takes the difference between the number of issues advancing on a given day, a positive number, and the number declining, a negative figure. Here's how a day-to-day reading of the AD line can help keep you on the right side of the market's primary trend. You can begin your calculations at any time by arbitrarily picking a large base number such as plus 50,000. You then calculate the difference between advances and declines on a daily basis. For example, if 692 issues are up and 912 issues are down, see Chart 8.5 from the Wall Street Journal's Market Diary. Disregard the unchanged issues. You come up with a net figure of 220. Subtract this number from your base figure of 50,000, and you get plus 49,780. If the next day's action produces more advances than declines, you add that number to the previous day's running total. As long as both the advanced decline line and the DJI are moving higher in gear with each other, there's nothing to worry about. It's very unlikely that the market will experience even a significant correction. However, when this indicator starts to lose upside momentum as the DJI continues to charge higher, that's a negative divergence signaling market trouble ahead. If the divergence takes place over a short period of time, several weeks, the decline is likely to turn out to be a correction within an ongoing bull market. If, however, the negative divergence continues to take shape over a long period of time, several months, that's a problem. On top of all this, if the DJI and the AD lines break down from important top formations, a new bear market is ready to descend on Wall Street. This clear-cut signal has worked time and again throughout market history. You are much more likely to see the AD line reach its peak before the DJI because, as confidence wanes, money moves out of the secondary stocks and into the higher-quality blue chips. Historically, the NYSE advanced decline line reaches its ultimate peak 5 to 10 months before the blue chips top out. Once the AD line stops rising, start becoming more and more suspicious about how much longer the bull will be able to stay alive. When it comes to a major bottom forming, the probabilities strongly favor that the DJI will reach its ultimate low and then refuse to drop further, while the AD line continues to move lower and lower. Rather than being a negative sign, as many market players believe, this is actually a long-term positive indication. It is the opposite of the negative divergence that forms in a stage 3 top, and thus is called a positive divergence. Such a divergence shows that some sectors are starting to shape up even as others continue getting clubbed. Whether you're dealing with a top or a bottom, remember that the longer that a divergence lasts, the more significant the eventual reversal will be. In the professional tape reader, I keep up advanced decline lines for the New York Stock Exchange, American Stock Exchange, the over-the-counter market, and the Dow Jones Industrial Average. I'll all provide insight into the market's subsurface technical condition. The only one that is crucial for you to keep up is the NYSE advanced decline line. It's not only listed every day in the market diary of the Wall Street Journal, but in just about every local newspaper's financial section. When you chart this gauge, make sure you graph it on the same chart as the Dow Jones Industrial Average. Both should be plotted on a daily basis. It will literally take you a matter of seconds to keep up this gauge, but it will vastly help you increase your profit potential. All you have to do is split your charting paper in half and come up with a reasonable scale for the DJI and chart that on top. On the lower half of the graph, chart the cumulative figure each day for the NYSE advanced decline line. Decide that each line on your paper is worth a given amount of net units of advances over declines, say 200 units per line. On the next day, if the DJI closes down 20 points, find that point on the Dow graph, plot it, and draw the line. When dealing with that day's AD data, if the prior day's reading was plus 50,000 and today there are 200 more declines than advances, the cumulative figure of plus 49,800 must be charted. Since each line equals 200 units, you drop down one line on the graph to chart today's reading. If, instead, there were 1,200 advances and 400 declines, then the net change for that day would be a reading of plus 800 units. Thus, you would move up 4 lines, since each line equals 200 units, to plot the AD on your chart. Market history is filled with examples of the NYSE advanced decline line reaching its peak prior to that of the DJI, and refusing to go one bit higher no matter how much further the industrials surged ahead. This syndrome demonstrates a market advance which is becoming dangerously selective. As confidence lessens, more and more money flows out of the broad market and focuses on only the highest quality companies. This is always an important early warning signal that the bull market's day of judgment is close by, and that you must watch your charts and indicators extra closely for further signs of the end. Chart 8.6 illustrates this pattern perfectly. While the NYSE AD line reached its peak in May of 1961, point A, the DJI didn't stop climbing until late that year, point B. There was almost a 7-month lead time between the two peaks. Several non-confirmations cropped up along the way as the industrials moved to new highs in August, September, November, and December of 1961, while the AD line refused to do likewise. This was ample warning that serious trouble was brewing. When the industrials broke below major support, as well as the 30-week MA, in early 1962, it clearly was time for the bear to start growling. The same bearish syndrome appeared in 1965. First, the AD line topped out in May 1965, even though the DJI continued rising for 9 more months. New DJI highs were registered in October 1965, and in January and February 1966, but all were unconfirmed by a new high in this important indicator. The advanced decline line's prior peak, as well as the series of unconfirmed new DJI highs, were strikes 1 and 2. Strike 3, and the signal that the 1966 bear market was getting underway, was the break below both key support and the 30-week MA in March of 1966. Perhaps the biggest and one of the best divergence warnings from the AD line appeared in the March 1972–January 1973 period. This gauge reached its peak 10 months before the January 1973 DJI top. In that long period of time, there were 4 new DJI highs that this indicator refused to confirm. This was a very powerful warning. It was hardly surprising that the DJI broke support as well as the 30-week MA in late January 1973. Commencing the most devastating bear market in over 40 years. Finally, this same telltale pattern appeared in 1987, before the worst one-day crash in the history of the market. While so many others were busy rationalizing that the crash was a product of our large budget and trade deficits, followers of this very reliable gauge knew differently. The two deficits were a silly excuse. They were both present as the market zoomed higher during the first 8 months of 1987, as well as when it crashed. The reality is that the market fell apart for the same reason it always gets walloped. It became too weak technically to advance any further. Whenever this happens, the path of least resistance is always down. Look at chart 8.7 and you'll see that this excellent gauge was invaluable once again in 1987. The NYSE advanced decline line reached its peak in March 1987, point A. At that point, the DJI was struggling to reach 2400. In the next 5 months, the bearish advanced decline syndrome appeared in all its glory. The AD line huffed and puffed, but could not blow past its March peak. Yet, during the same period, the DJI moved above 2700. 4 unconfirmed highs were registered by the DJI in April, June, July, and finally, August 1987. By the time the Dow's intraday high at 2746 was hit, the only argument that was taking place among most market players was how soon Dow 3000 would be topped. This was significant foreshadowing, and a few weeks later when the DJI broke below its major support near 2490 and then its 30-week MA, the die was cast. A bear market was in the cards. The only surprise was that what usually takes several months to accomplish occurred in just a few short weeks, as the computerized sell programs compressed the action. It's important to be aware that a bullish divergence forms in a far different manner. After the 1929 to 1932 crash, both the NYSE advanced decline line and the DJI moved in sync on the downside. Then, in July 1932, Both gauges registered new lows before starting sharp rallies. Almost 8 months later, in late February 1933, an interesting phenomenon took place. The DJI hit bottom and then started to rally. The advanced decline line, however, told a different story. The AD line continued declining throughout the entire month of March while the industrials rallied. This is typical action as a major bottom forms. Since confidence is naturally in short supply after a protracted decline, buyers are extremely cautious when they first put their toes back into the buying pond. Buyers initially gravitate toward the quality issues while shunning the more speculative ones. Therefore, it's not surprising that this favorable sequence of a new low in the AD figures unconfirmed by a corresponding low in the DJI can be found at several major bottoms over the years. Another textbook case of this phenomenon occurred in late 1957, Chart 8.8. After being smashed in the second half of that year, the DJI hit bottom in October. A. Over the next 2 months, all declines saw the industrials hold above the October low as a stage 1 base started to form. But the AD line remained under pressure during that period, and it broke to new lows. B. This divergent action soon was followed by the great 1958 to 1959 bull market. This bullish pattern reappeared after the 1962 crash. See Chart 8.9. Those technicians who knew their market history were in a position to buy while the street was in a panic over the Cuban Missile Crisis. The Dow reached its crash low in late June of that year. A. Months before the headline events. During the following 8 weeks, both gauges enjoyed a nice technical rally. Came the historic September-October sell-off with Cuba, missiles, and Russian warships shaking up far more than just Wall Street. B. Interestingly, amid all the fear and the AD line hitting a new low, the DJI held on the 1-yard line and refused to break below its June 1962 bottom. With anxiety at epic levels, this was a very powerful divergence signal. Once Khrushchev turned his ships around, the market started a fabulous 3.5-year bull market. This very profitable pattern again appeared on the financial scene in mid-1970. After the wicked 1969-70 bear market, the DJI bottomed in May 1970, while the AD line continued to crash until it finally hit its low in July. This was a great timing signal that the 1970 to 1973 bull market was ready to go into orbit. Finally, this positive pattern showed up on the charts in the June to July 1984 period, after the January to July junior bear market. Within days, the incredibly powerful July 1984 to August 1987 bull market was underway. Measuring the market's momentum. There are several other ways to use the NYSE advanced decline figures. Weekly figures give you another perspective for long-term analysis. Daily figures can also be charted on a point and figure basis, rather than in the bar chart manner that I've just taught you. Finally, short-term oscillators can be constructed for trading purposes. Each facet provides an added insight into what the market is up to. I use all of these in the professional tape reader because I feel these important statistics are basic to technical analysis. But you can get a pretty good advanced decline overview if you just follow the daily figures on the divergence basis I just taught you, in conjunction with one other long-term method. This indicator has the advantage of being 1. Very accurate, 2. Easy to interpret, and 3. Quick to calculate. I call this gauge my momentum index, MI. It is actually a 200-day moving average of the NYSE advanced decline figures. By measuring momentum in the market, you are actually applying Newton's law of physics, except that when dealing with stocks, it should be rephrased to say that trend in motion can be expected to continue until it reverses. In other words, forget about minor zigs and zags and keep your eye on the major trend. This is where the momentum index, chart 810, can help you. The first step is to collect the NYSE advanced decline data for the latest 200 market sessions. If you are industrious, you can go to your local library and get the numbers from back issues of Barron's. If you don't have the time, simply start jotting down the figure as of today, and in 40 weeks, you'll have a complete set of data. The next step is to add up all the pluses and minuses for the 200-day period. After you get this total, divide it by 200. This answer is today's momentum index. After collecting the data for 200 days and calculating today's index number, this gauge is very simple to maintain if you use the following shortcut. There is no need to add up the entire 200 days of data again. As with calculating any MA, simply add the new day's data into your calculator. When adding, you enter whatever sign you see and subtract the 201st day's data. When you subtract, you must remember that you have to reverse your sign. Don't forget to physically cross out the 201st day on your data sheet. Otherwise, tomorrow you may not realize that it's already been taken out, and you'll mistakenly use the same day again. The final mechanical step is to take the difference of these 2 days' data, the new day and the 201st day, and divide it by 200. When you get that answer, add it to yesterday's MI reading and you have today's new momentum index. Here's a real-life example of how to quickly execute this calculation. On November 11, 1987, the MI reading was -63. With this information in hand, let's see how you should have calculated the answer the next day. On November 12th, there were 941 more advances than declines on the New York Exchange. Thus, I put a plus 941 in my calculator. Next, I checked the data sheet and saw that the reading from the 201st day, January 29, 1987, was -82. Remembering to reverse signs, I entered a plus 82 into my calculator and crossed out that 201st day on my data sheet. The total of the plus 82 and plus 941 equals a plus 1023. Divide the 1023 by 200, and you get a reading of plus 5.1. The final step is to add the plus 5.1 to yesterday's momentum index reading of -63, yielding a new MI reading for November 12th of -57.9. Over the years, I've developed a few useful rules for interpreting this helpful indicator. 1. The most important signal is a crossing in either direction of the zero line. If the momentum index has been in negative territory and then crosses above the zero line, that's a favorable longer-term signal. On the other hand, a drop from positive to negative territory is a bearish indication. 2. The longer the time period that this gauge has been either above or below zero, the more meaningful the signal is when it moves across the zero line. 3. The most significant moves are those which take place when this indicator has been deep in positive or negative territory for quite a while and then crosses the zero line. This stands in contrast to those occasions when the MI hovers near the zero line and then pops across it. 4. The most meaningful bearish signals occur when the MI has been in positive territory for quite a while and, at the extreme, moved far above the zero line before giving a bearish signal. 5. In a bull market, this gauge will almost always reach its peak before the Dow Jones Industrial Average does. Even though it may hang on to a marginally positive reading for the remainder of the bull market, an early warning signal is given even while it's still in positive territory by a sharp drop from its peak reading. One look at Chart 810 will show you that the pre-crash action in 1987 was a textbook case of this syndrome in action. The MI actually reached its peak in mid-1986, even though the Dow had another year of bullish action ahead of it. While there was no reason to sell just because the MI was starting to lag, it was clear that it was becoming dangerously late in the day for the bull market. Note that even though the first 8 months of 1987 were a bullish fantasy, this gauge was quite mediocre throughout that period. The fact that the Dow could move up so many hundreds of points and not have an impact on this indicator was certainly an important warning. In October, before the October 19th Black Monday crash, this indicator dropped into negative territory. This was yet another warning that, contrary to Wall Street majority opinion, the coming decline was not a correction in an ongoing bull market, but a full-fledged bear smash. This long-term indicator has identified the onset of several other bear markets in very timely fashion. Excellent sell signals were flashed in January 1962, early 1969, early 1972, spring 1981, and January 1984. This indicator is more helpful at spotting tops than bottoms. Sell signals generally come relatively early at tops, giving advance warning, but they are somewhat late at bottoms, acting more as a confirming signal. As long as you are aware of that, however, the MI can still be a great aid to you on the bullish side, too, by helping you distinguish flash in the pan rallies from the real thing. Confirming buy signals were flashed in February 1961, the spring of 1963, April 1967, January 1971, early 1975, August 1982, and January 1985. Over the years, this fine long-term gauge has foreshadowed many important market moves. When combined with the few other long-term indicators that you're learning in this chapter, you have an excellent arsenal of technical tools to cut through the fog created by Wall Street and the media. Simple, but effective. The next long-term indicator is very useful in gauging the market's true subsurface technical condition, but don't ever use it in a vacuum. It shouldn't be judged alone, but only as part of our team of indicators. Whereas the DJI in relation to its 30-week MA gives very specific signals, this gauge does not. It does tell us when the market's technical health is quietly starting to fail, even though everything may still look great on the surface. On the other hand, it will also often show subtle strengthening, even though the averages are still getting bombed. Its message will almost always be very early, giving you plenty of time to plan for a change in market direction. Then, when the majority of our other long-term indicators start to agree with this early signal, you'll know it's time to make an important move. I want to stress the importance of keeping in touch with the new high, new low figures. There are actually a few different sets of figures, and each is helpful in its own way. The most commonly followed high-low numbers are the daily ones published each morning in the Wall Street Journal and most local newspapers. These figures, however, are based on all stocks, including preferreds. While they are helpful, I prefer the common stock-only data. They are harder to obtain, but are available in some papers such as Investors Daily. These figures are excellent for traders to track on a daily basis, as they often foreshadow very meaningful short to intermediate-term moves. I track them in PTR along with all of the other indicators that we've been going over. Since I want you to get the maximum return on your limited time investment, I suggest you track the weekly figures rather than the daily ones. The weekly new highs and new lows will point out much more meaningful moves and also filter out a lot of trading static that investors don't need to be concerned with. Also, you'll save a lot of time in keeping up the indicator. Now that we've settled on the weekly data, we're still presented with another choice. Just as with the daily figures, there are the conventional figures which appear in most newspapers and are based on all stocks, including preferreds, and those that reflect common stocks only. While both are useful, and I keep an eye on both sets of statistics, I again prefer the common stock-only weekly figures. To see the subtle differences in the two sets of data, let's examine the numbers for the trading week ending October 23, 1987. This was the crash week that included Black Monday, October 19th. The conventional NYSE figures showed 12 new weekly highs versus 16 new weekly lows. To calculate this indicator, subtract new lows, which are negative, from new highs, which are positive. The net reading for this week was a -1504. This was one of the largest negative readings in market history. The corresponding weekly figures for the common stocks only were 8 new highs versus 1,058 new lows. The net figure was a -1,051. You can see that, when you exclude preferred stocks, warrants, and the like, there is a significant difference in the sizes of the two numbers, although not usually in the overall direction. So although the common stock-only figures are preferable, if you have to use the conventional data, it is still valid. The greatest variance between the two sets of data occur when interest rates stage a significant move, which has a profound impact on preferred stocks. As you have already seen, the calculation is easy. When it comes to charting, all you have to do is set up a scale for the DJI on the upper half of your graph paper and one for this gauge on the lower half. Each weekend, plot the closing Friday DJI level versus this figure. Now let's move on to interpretation. While there are several ways to use this data, I find two to be easiest and most profitable. First, when this gauge is consistently in positive territory, it is a favorable long-term indication. When it is in negative territory week after week, you're dealing with an unhealthy market. Second, when an important divergence takes shape, a reversal in the trend is starting to form. A perfect example stands out on chart 811 in 1982.E. Even though this gauge remained in negative territory, showing that the major trend was still bearish, something very bullish and exciting was taking place. While the DJI continued to move lower and lower throughout the first 8 months of 1982, this key indicator started trending higher during that period. This showed that fewer and fewer stocks were actually following the widely watched average in its downward direction. It was a sign of subsurface technical strengthening. This was a perfect case of a positive divergence, and was one of several key non-confirmations that helped me turn bullish in July of that year, before the historic bull market started in August. The same manner, in late 1974, the market continued to move sharply lower while this gauge started sloping gently higher. This was a beautiful foreshadowing of the powerful 1975-1976 bull market. On the other hand, while the DJI was moving higher in the late 1972, early 1973 period, the differential was trending lower. Point A. This action clearly tipped off the coming 1973 to 1974 bear market. The same pattern again was in evidence in late 1976, point C, early 1981, point D, and late 1983. All three negative signals occurred right before significant bear markets. Now look at the 1987 super rally, point G. While the market zoomed ahead, this indicator refused to move higher and actually trended somewhat lower. This showed that something was rotten beneath the surface. When the gauge further weakened in October, in tandem with several of our other indicators, you knew that big trouble was on the way. The October 1987 crash certainly fulfilled that prophecy. It should therefore be obvious that this easy-to-construct long-term indicator is one that you must always keep an eye on. No isolationism here. With today's instant communications and all of the United States trading partners having more than a passing interest in the strength of our dollar, the foreign stock markets are more tuned into each other than ever before. Properly interpreted, this increasing interdependence can be a very useful long-term indicator for our market. It is very easy to keep track of what is going on around the globe by utilizing the statistics that Barron's reports each weekend in their International Trader section. See Chart 812. They report on 18 world stock markets in addition to our own. Prices for all markets are given in terms of local currencies and US dollars. Since the dollar has gyrated in yo-yo fashion in recent years, I find it more meaningful to use the local currency prices. All you have to do is chart these markets on a weekly basis and watch for significant chart formations. My studies have convinced me that the most profitable market moves in the United States occur when the overwhelming majority of world markets are in agreement. This is true on both the upside and downside. Way back in early 1973, PTR stated, "The London Industrials staged the sharpest single day's drop in its entire history. A broad top has been completed and a bear trend clearly established. But rather than fret about the losses Britons are in for, keep in mind the serious warning this leading indicator is for our own market." Both their market and ours soon crashed. It wasn't just London Chart 813 that got in trouble. All of the foreign markets did. Australia, France, London, Japan, and West Germany were especially negative, breaking down from major stage 3 top patterns. France, Chart 814, gave an especially timely sell signal as it broke below major support and completed its top in late 1972, several weeks ahead of the DJI's peak in January 1973. The same storyline unfolded in 1981, right before the April 1981 to August 1982 bear market blindsided Wall Street. Austria, Chart 815, flashed a bear market signal in early 1981, several months before the U.S. market topped out. In addition, France Chart 816 once again was right there with its bear market signal as our market was reaching its peak. Both of these early warnings made it clear that it was time for you to get your investing house in order, as the probabilities were high that bearish trouble would soon reach our shores. Just in case there was any doubt, Australia, Canada, Hong Kong, and Singapore all chimed in with their own bearish message. The end result was a very rough 16 months as the 1981-82 bear market ran its course. The good news is that this long-term indicator works equally well on the bullish side. Amid all of the gloom and doom that was rampant on Wall Street back in the first half of 1982, this gauge was definitely an early ray of sunshine. The United Kingdom, Chart 817, started trending higher in late 1981, and both the Netherlands and West Germany formed solid stage 1 bases while our own bear market ground relentlessly lower. Then, all three confirmed that bullish tidings were ahead for our market starting in the second half of 1982, as they all staged major upside breakouts. It's obvious this is a financial pulse that you want to monitor closely. However, it does demand considerable time, so here's good news. A simple way to follow this indicator is to chart only the world market average on a weekly basis. Barron's supplies this number in its table of global stock markets, chart 812. It will give you a very close approximation of what is going on with all of the foreign stock markets, just charted each weekend. In addition, calculate and chart a 30-week MA for the data. As you can see on chart 818, this key long-term gauge flashed an important buy signal when it moved above its 30-week MA in the summer of 1982. Point A. It remained in a favorable position until the late 1983 period when a stage 3 top formed. Thereafter, in early 1984, this average weakened even further, breaking below the MA point B. This negative action correctly dovetailed with the January to July 1984 junior bear market. This gauge showed exceptional strength later in 1984 point C, as it broke out on the upside ahead of the U.S. market. This proved to be an excellent signal of the exciting 1985 to August 1987 bull move that was gathering steam in the United States. Then, after close to 3 years of incredible strength, the world average started tracing out a clear-cut stage 3 top point D. This was another reason to become defensive after the August peak in the United States. Finally, once key support and the 30-week MA were violated in October point E, you had another clear sign that to continue dreaming about Dow 3000 would be suicidal, as GM goes. During the late 1950s, cabinet member Charles Wilson commented that what's good for GM is good for America. General Motors is no longer the dominant corporation it was then, but it still casts a very long shadow. The market is not a democracy. The bullish and bearish votes that each stock casts toward the major trend most definitely do not count equally. The most heavily traded and owned institutional favorites matter far more than the over-the-counter secondary stocks. Of all these shakers and movers, there is one that you must always keep your eyes glued to: General Motors. Never listen to the message of this key stock in a vacuum, but when it flashes a major signal that is in sync with the majority of the gauges in this chapter, do not ignore it. An added bonus is that this indicator takes so little time to follow. Just be sure to note General Motors' action when you flip through your charts. There is a popular method that many use to measure this key stock's health, or lack thereof. It's called the 4-month rule. Simply stated, if GM doesn't make a new high or low within 4 months, it is a signal that GM's prevailing trend is reversing. Over 70% of the signals of the 4-month rule have been profitable in the past 50-plus years. Even more impressive is the fact that not one of its failures was off by much more than 10%. And to its credit, many of the signals on the plus side scored fabulous gains. I follow the 4-month rule in PTR, and it's worthwhile for you to do so also. But what I've found to be far more helpful in timing the market is to apply stage analysis to the General Motors chart. If the two methods disagree, always go with the message being flashed by our charting technique. When it completes a stage 3 top and breaks down into stage 4, it's time to worry even if a new GM high was hit last month. The reverse is true when General Motors breaks out of a stage 1 base. One other factor to bring into the picture is the concept of divergence analysis, with which you should now feel more comfortable. GM refuses to make a new high or low, in tandem with the DJI and the other leading averages. It's an early warning that you'd better be alert. Chart 819 shows an excellent example of GM helping to spot an important bottom. During the 1973 to 1974 bear market, new lows came along on schedule to verify that the worst bear slide in a generation was intact. But in mid-1974, life changed for GM. First, it broke above its downtrend line, next it completed a double bottom, and finally it jumped above its 30-week MA. This very favorable signal coincided with the start of the dynamic 1975 to 1976 bull market. The market was no more tricky during the 1981 to 1982 bear trend, chart 820. While the averages moved relentlessly lower, GM started to form a stage 1 base as early as the first quarter of 1982. In May of that year, the stock moved into stage 2, which was a very early warning that the bear was close to expiring. Interestingly, I turned bullish in July when the majority of my indicators finally got in favorable gear with GM. But it wasn't until August that the market averages hit their bear market low, and the bull was born. Don't believe what so many market players do, that you have to bargain hunt because bear markets reverse so quickly. This is absolutely not true. There is plenty of technical foreshadowing that takes place before an upturn materializes. When you do your technical homework, you'll spot it. Unlike some gauges, such as my momentum index, the GM signals at tops are as timely as those flashed at major lows. In early 1966, GM flashed danger as it refused to better its 1965 high, even though the DJI catapulted to a new peak reading. This divergence was an important warning. Another negative signal was the poor relative strength and toppy stage 3 action that formed in early 1966. Finally, there could no longer be doubt that trouble was on its way once it broke below support and the MA. Soon thereafter, the 1966 bear market was in the record books as prices broke sharply. This indicator didn't tip off the 1969 to 70 bear market that would be too subtle. It yelled it. While the DJI moved back within inches of its 1966 high in December 1968, GM failed miserably. It didn't come close to its 1966 high, and in early 1969 it broke below its MA. Trouble was on the way. GM did an equally good job of warning of danger before the 1973 to 1974 bear market. Not only did GM not move to a new high in January 1973, as did the DJI, it couldn't even come close to its 1971 peak. That divergence was scary. When it smashed below support and the 30-week MA in early 1973, see Chart 821, you should have known it was time to turn away from the good news and start selling. Finally, let's examine more recent action. Did this indicator offer any selling clues before the historic October 1987 crash? You bet it did. As with every other gauge in this chapter, GM said sell before the 1987 crash. Look at the 1987 price action in Chart 822. Even though General Motors hit a new high that August, trouble was signaled only a few weeks later. This is why I always place much greater emphasis on flexible systems like stage analysis than a rigid system like the 4-month rule. Those investors and analysts who blindly follow the latter method believed there would be nothing to worry about at least until December. But when you look at the chart, you should see why danger was clearly signaled in the late September, early October period. GM suddenly reversed and first broke below its long-term uptrend line. Then it violated its 30-week MA. While all of this was taking place, the DJI was rallying from near 2,500 up to the mid-2600s. This was a reason to be concerned. If the other few gauges that you've just learned were in fine shape, you could have worried a bit less. But every one of these indicators was in poor shape. I therefore advised PTR subscribers to move to a very defensive position. Remember, it's tough for any market to go up in a sustained attack if GM can't join in, and equally hard for the bear to keep its grip if GM refuses to go down. Therefore, this simple indicator is one to watch closely. When it flashes a definitive signal that is in harmony with the majority of this chapter's excellent long-term gauges, you'll be ignoring its message at your own peril, cheap or dear. This next long-term gauge shows that I really am a pragmatist. Although I strongly believe in the technical approach, I always strive to be as objective as possible. When giving seminars, I often joke that if throwing darts at the stock listings would give me the right answer 80% of the time, it would become the 51st indicator in PTR's weight of the evidence. Technical or fundamental, all I want is greater insight into tomorrow's likely market action. Unfortunately, the predictive value of most of the fundamental gauges that I've tested isn't reliable enough. A few are, however, and the best one is the price and dividend ratio. This very long-term tool expresses stock prices as multiples of dividends. In other words, what would it cost you in terms of stock price to buy $1 worth of dividends? Before digging deeper into the theory, here's how to calculate the P&D ratio. Each weekend in Barron's Market Laboratory section, there is a table C Chart 823 titled Indexes P and E's and Yields. The Barron's of November 23, 1987, had the following input. The yield on the Dow Jones Industrial Average as of the close on November 20th was 3.58%. Elsewhere in the Market Laboratory section, we find out that the DJI closed at 1914. The next step is to multiply the DJI close by the percentage yield. DJI Friday's close times percent DJI yield equals dividend payout of DJI. In this case, the figure is 68.52. 1914 times 3.58%, which must be changed to 0.0358 when put in decimal form, equals 68.52. That's $68.52 is the amount of dividend currently being paid by the 30 Dow blue chips. We are now ready for the final step. Since the indicator is the price and dividend ratio, all that we now have to do is plug in the price of the DJI and then divide by the dividend, 1914 divided by 68.52. This gives us a P&D ratio reading of 27.9, round the decimal off to one place. We're now ready to swing into action. This very long-term gauge is excellent for spotting major top and bottom zones. Everyone talks in terms of the market being cheap or expensive, but that is subjective. This, however, is a way of objectively deciding. Declines in the P&D ratio toward the 14 to 17 area have appeared at times when common stocks were uncommon bargains. On the other hand, when stocks become dear in terms of their return, then it's time to be on guard against a major top forming. A move above 26 has historically been a dangerous reading, while a figure above 30 has been a sign that stocks are extremely overvalued. Before going further, make sure you realize that although this is not a pinpoint indicator, it is incredibly helpful, but only when used in conjunction with the timing gauges in this chapter. Understand that a favorable or unfavorable signal will often appear well before it is time to take action. A bearish figure means the market is entering a high-risk zone that will almost surely be followed by a crash. But that bear market may still be a year or more away. So if all of our other long-term indicators are still bullish, continue to play the long side with a close eye on the exit. The opposite is true when this gauge turns favorable. A perfect example occurred when the P&D ratio dropped to a very low and favorable level in 1932. This gauge correctly showed that an incredible bull market was in the wings, but you shouldn't have become aggressively bullish until our timing tools, such as the DJI in relation to its MA, turned positive. On the favorable side, very bullish readings were registered in 1932, 1937, 1942, 1949, 1974, and 1980. Each and every one was followed by a very profitable bull market. But some readings, such as those registered in 1932, 1942, and 1980, were over a year early. So view this indicator as one that spots a bullish or bearish potential forming, but until the spark, which our timing gauges spot, occurs, there is no explosion, even though gas is pouring into the room. On the negative side, high risk levels were reached in 1929, 1936, 1939, 1959, 1961, 1965, 1968, 1972, and 1987. The 1987 signal was especially helpful as the price-dividend ratio neared the 40 level, the most dangerous reading of the previous 20 years, and one of the highest in history. It's not surprising that the October 1987 crash was so severe, since this gauge was showing plenty of excesses to be wrung out of the tape. Once again, this ratio turned clearly negative in early 1987, though the majority of our other long-term indicators didn't join the bearish party until after the August 1987 peak, going against the crowd. All of the gauges that we've been reviewing have at least one thing in common: they are objectively measurable. They are all based on specific statistics, such as advances and declines, or new highs and new lows. There is one indicator, however, which is subjective and doesn't rely on any specific signals, yet is very helpful. It's known as the theory of contrary opinion. This theory relates to the innate herd instinct that afflicts investors. A basic tenet of this theory is that people feel most secure when they are in the mainstream. For this reason, investors form a consensus opinion. They reinforce each other's beliefs and block out evidence that would support other conclusions. In the market, this behavior leads to excessive optimism just before a crash and general pessimism at the very bottom. People who use the theory of contrary opinion to good effect try to find out what the consensus opinion is, then act in just the opposite manner. Before going any further, I want to caution you. Contrary opinion, is a very valuable tool when used properly. Unfortunately, not one investor in 100 really understands it, although everybody and his broker wants to be sophisticated and think they are using CO. Do not make the mistake of so many contrary opinion buffs and try to force an answer from CO every week or even every few months. A true CO signal may not arise for a year or more. It is only valid when a prevailing theme starts to play through the media and is thoroughly accepted from Wall Street to Main Street. Don't think CO consists of merely calling your broker, finding out he is bullish, and then deciding you are bearish. The trick is to wait for a very obvious one-sided opinion to form, whereby everybody suddenly believes he knows something, and then to become suspicious of that conventional wisdom. I thoroughly believe in the slogan that says, when everybody knows something, it isn't worth knowing. When a truly one-sided opinion really grabs the street, it becomes so heavy you can almost cut it with a knife. One other word of caution: I disagree with those who believe that contrary opinion alone is enough. Not true. I view CO as a psychological potential, just as the price-dividend ratio represents a value potential. Neither one should ever make you buy or sell stocks if all the timing gauges disagree. When CO gets the agreement of the other technical tools, then get set, because a big market move is getting ready to unfold. The next question is, how should you try to judge contrary opinion? Most analysts choose to use the bullish and bearish sentiment figures that are compiled by services such as Investors Intelligence. While I track these figures and do find them useful, they fluctuate quite a bit. For really major signals, I much prefer to skim through the financial press. Magazine and newspaper headline writers don't mean to be an indicator, but are they? Since they are trying to sell papers, they want to hit the right nerve. If they sense that the public is jittery, fear is what they feature, while in bullish times, we see a steady torrent of optimistic headlines. A headline or magazine cover is often all that is needed to trigger a prompt, "That's got to be wrong" response on your part. Then, when our other indicators agree, you know the market is ready for a really important move. A perfect example of the cover story syndrome was provided in late 1974. After the worst bear market since 1929, one of the leading financial magazines put a picture of a big black scary bear on its cover. For emphasis, they showed the bear knocking down the pillars of Wall Street. And so many of my other long-term indicators were also turning positive at the time. This was a perfect time to disregard the fear syndrome gripping Wall Street and start buying. Another classic contrary opinion signal was flashed in the summer of 1978. A different major business magazine ran a cover story titled "The Death of Equities." Not surprisingly, the market staged a major advance that lasted almost 3 years. Harder to believe, but just as true. That same magazine ran a new story on the same topic 5 years later. This time they featured a charging bull on the cover with a headline that read, "The Rebirth of Equities." Interestingly, this was late in the spring of 1983. Only a few weeks later, in June, speculative stocks registered a major high and then crashed. The blue chips struggled higher for a few more months before getting hit hard in the January to July 1984 junior bear market. I don't mean to pick on any specific magazine or newspaper, because the media is merely representing the psychology of the moment. Just be aware that it shows up time after time in the press, and you have to learn to use it properly rather than letting it wrongly affect you. Even better than a headline are many headlines, all reinforcing the same sentiment. Look at the montage chart 825 that appeared in the professional tape reader in late 1974, and you'll see exactly what I mean. After the devastating 1973-1974 bear smash, headlines spoke of huge layoffs, plunging earnings, and a possible world depression. We all know, or should know, that the market is supposed to top out on good news and hit bottom on bad news. All too many investors forget that truism and move with the news. Headlines reporting such scary news drive the consensus of opinion to believe the market is going to crash much further. That's when an important bottom is invariably formed. It's no coincidence that the market at the time of these headlines was within a few weeks of terminating its worst crash since the Great Depression. Now shift your attention to chart 826. When I ran this montage of over-optimism, the street was really whipping itself into a bullish frenzy. One of the most prestigious newspapers in the country told us the bulls are coming. In addition, the prime rate was dropping and earnings were rising. Wouldn't you know that the market was within days of reaching its 1976 peak of 1,026? Since so many of the long-term indicators were also turning negative, it was very predictable that the September 1976 to February 1978 bear market was starting. The pattern is always the same. Another fine example of contrary opinion was provided in the summer of 1982, Chart 827. While so many analysts and investors were convinced that a severe recession and Dow 500 were just around the corner, I flashed a major buy signal because the overwhelming majority of my key indicators turned positive against this negative news backup. Finally, let's examine what the psychological climate was in 1987 as that major top was forming. One of the scariest headlines from a CO point of view was the one I reprinted in late August that said, Dow 3000, not if, but when. Chart 828, for a major financial magazine to feel so strongly that the upside was the only side was a significant signal. Added to my other technical gauges that were weakening, this caused me to adopt a very defensive position which helped PTR subscribers sidestep the historic 1987 crash. To make matters worse, once the market started sliding, it was met with calm rather than panic. From now on, be very aware of headlines. When this indicator finally speaks, and when it gets agreement from our other gauges, be sure you listen to its message. Chapter 9. Odds, Ends, and Profits. You're almost there. If you never learn a winning market tactic other than those I've already taught you, you're going to do very well in the market as long as you faithfully apply my techniques. Now we're going to put the finishing touches on your education. To refer back to our tennis analogy, you definitely know enough to be a winner, but now you're going to learn the advanced techniques that can make you a champion. Now that you have mastered stage analysis, be aware there are several other areas besides stocks where it can be applied very profitably. Fun with funds. The first area to move into is that of mutual funds. This is a game that is both easy to master and has relatively low risk. Most investors view mutual funds as very long-term investments that should be bought and locked away through thick and thin. This is foolish for several reasons. First, once you know how to time major moves, why in the world would you want to sit through a stage 4 bear trend? Second, more and more funds have gone the no-load or low-load route. Finally, there are now many funds that offer both an aggressive stock fund as well as a money market fund. To induce you to keep your money in their coffers, they allow switching back and forth between funds, usually with just a phone call. This immediately sets up the potential for a very profitable trading and investing game. All we have to do is buy an aggressive fund when the market turns clearly bullish, such as in mid-1982 and late 1986, and sell and move into a money market fund when stage 4 appears, as in January 1984 and early October 1987. When I first started recommending mutual fund switching many years ago, there were only a handful of funds that offered this opportunity. But the growth of the mutual fund industry has made it commonplace. The weekly chart of Stein Row Capital Opportunity, Chart 9.1, shows how easy it is to implement this strategy. In the summer of 1982, the 30-week moving average finally leveled out after trending lower for 14 months. Then, when the fund moved above its 30-week MA at $13.50, a low-risk buy signal was flashed. Since you can't physically place sell stops on mutual funds, you must use mental stops, meaning that if it closes below your sell stop point, you'll immediately call the fund and sell it. In this case, the stop should have been set initially under the low at point A. Once this chart turned favorable, it was simply a matter of holding on while the fund rocketed higher. 1 year later, when Stein Row broke below its MA, it was time to move out of the aggressive fund into a money market fund with a 100% profit in hand. The advantage of using mutual funds to capitalize on the market cycles is that you don't have to pore over page after page of individual stock charts. All you have to do is keep up a few charts of some of the better acting funds along with their 30-week MAs. This only takes a few minutes on the weekend and is well worth the effort. If you aren't familiar with how to calculate a 30-week MA, relax. First, reread my description of the moving average in Chapter 1. Then come back to this example and you'll get it easily. To get the first plot for your 30-week MA, simply add up the 30 weeks on your calculator or computer and get the total 853. Put that answer in the total column. Then divide by 30 and you have your starting point for the MA, 28.43. In the following weeks, there is no need to repeat the lengthy process of adding up the new 30 weeks. Simply add the 31st week, 27.2 to last week's total. Then subtract out the oldest week. The oldest week's total in this case is 30.0. Remember to cross it out on your data sheet from last week, total of 853. This gives you a new total of 850.2. Divide by 30, and you have the new 30-week MA of 28.34. With this method and a pocket calculator, you can keep up several moving averages with just a few minutes' work. The weekly chart of the Value Line Special Situation Fund. Chart 9.3 shows that after getting a buy signal in late 1986, you would have gotten an even more timely sell signal in early October 1987, before the historic crash. The decline that took place within the next few weeks was nothing short of astounding. By following our system, you could have calmly watched that historic crash from the safe harbor of your money market fund. Before proceeding, let's deal with the question that you're probably getting ready to ask. Since this exciting mutual fund technique looks so easy and profitable, should you forget about stocks and use it exclusively? My answer is, for most of you, no. The potential is more dynamic in individual stocks than in funds, so it would be a mistake to totally ignore that area. But depending on your personality and the time you can allot to the market, you should work out the mix between mutual fund switching and stock purchases. If you are very committed to the market and want to devote a couple of hours a week, you should obviously place a greater emphasis on stocks and less on funds. But even this type of investor should place some capital in the switch fund game. I especially recommend that you use fund switching for your IRAs, individual retirement accounts, and pension funds, while putting your more aggressive money into individual stocks. If, on the other hand, you have very little time available to devote to the market, then it certainly makes sense to lean much more heavily on funds than stocks. The simple rules I've just shown you for buying and selling when the 30-week MA is violated works very well for investors. There will be very few signals, and they can catch all the major moves. Traders, however, must use a daily chart with a 30-day MA. The potential is even greater, but more work and attention are required. In addition, there are more frequent signals and whipsaws. That is why you should decide if you are more comfortable investing or trading. Short-term fund trading. Chart 9.4 of Scudder International Fund shows how accurate the trading approach can be. After catching a super advance from late 1986, point A, until May of 1987, the fund sent a short-term sell signal as the daily price edged below the 30-day MA. While the sell signal turned out to be a whipsaw, a great profit was locked in, and the fund should have been repurchased when it broke out again and moved to a new high in late June, point B. Again, this second upside ride was exciting and profitable until a timely sell signal was flashed in early October, point C, right before the October crash. Be aware that when you are dealing with daily fund charts, you should pay equal attention to the chart formation and 30-day MA to keep whipsaws to a minimum. While you should always trade out of the fund if it breaks below the 30-day MA, buy the fund only if it both crosses above the short-term MA and breaks out above resistance, as Scudder did at points A and B. The next question that arises is how to determine which no-load mutual fund to purchase when several give simultaneous buy signals. While they're all likely to be winners, if Fund A advances 15% while Fund B runs ahead 30% in the same time span, it's obvious which one we want to be holding. It's easy to determine the likely winner of the race when you learn to use a few tricks. The secret doesn't lie in getting the fund's prospectus and trying to figure out which stocks look best and which areas the fund is invested in. First of all, this would be ridiculously time-consuming. Secondly, mutual fund managers change their portfolios so rapidly that the prospectus you're reading is most likely out of date. A method that is far simpler and has a much greater probability of success is to compare the relative strength of the different buy candidates in the 60 to 90-day period before the buy signal is given. First, check out the percentage advance in this period from the low to where it is when the buy signal is flashed. The fund with the greatest percentage gain while still in a Stage 1 base almost always leads the pack in Stage 2. A second helpful hint is given if one fund breaks out a few days before a second fund. The fund that broke out first is exhibiting better relative strength. Finally, check out the action of the moving average. If one fund breaks out above an MA that is still declining while the second fund jumps above a level MA, then the second fund is the preferable choice. If, as often happens, all three of these relative strength measurements point to the same buy candidate, don't hesitate by it. On the other hand, if you get mixed signals and there's no clear-cut answer, then the likelihood is that all will perform in a similar manner. Don't think this method is strictly for risk avoiders and old fuddy-duddies. A well-disciplined approach to no-load mutual fund switching can yield surprisingly good results with a minimum of potential downside risk. To see what I mean, look at Chart 9.5, which shows the results that were achieved in the professional tape reader over an 8-year period. While the methodology used was a little different, most of the trading signals were based on my proprietary Group Intensity Trading Index, which is reported in each issue of PTR. The results that you would have achieved using the simple method I just taught you would be quite close to those in the table. Note that $100,000 increased more than fivefold in this time span to over $530,000. This works out to be a compounded annual increase of 23%, which sure beats the heck out of 5.50% at the bank, where so many people leave their IRA money. As I promised, here is a list of some of the no-load funds that have impressed me with their action over the past several years. In no way is the list meant to be all-inclusive. When rating services such as Lipper Analytical come out with their new performance figures, it's easy to see which funds are acting best and merit your attention. Those who want to know which few funds to begin charting, this list is a good starting point. Columbia Growth, PO. Box 1350 Portland, or 97,207, 800-547, 1037. Constellation Growth, 11 Greenway Plaza, Suite 1919, Houston, TX 77,046, 800-231-0803. Fidelity Fund, one of several funds in the Fidelity family of funds. 82 Devonshire Street, Boston, MA 02109, 800-544-7777. Hartwell Growth, 515 Madison Ave, New York, NY 10022, 800-645-6405. Lexington Growth, Park 80 West, Plaza 2, Saddle Brook, NJ 07662, 800-526-0056. 20th Century Growth, 605 West 47th Street, Kansas City, Mo 64112, 800-345-2021. Vanguard Morgan Growth Fund, PO. Box 2600, Valley Forge, PA 19482, 800-662-7447. While mutual funds offer great promise, it's important to be aware of a few curves that can be thrown at you. Obviously, there's always the potential, as with stocks, for a whipsaw signal. Another point to be aware of is that many funds limit the number of switches you're allowed to make in a given time period. Some of the funds are very reasonable and allow either unlimited or a very large number of switches per year, as long as you don't abuse this privilege by buying and selling in a foolhardy scalping manner. Some funds charge a small penalty fee after a certain number of switches. It's therefore important to get a prospectus for each fund you're charting and familiarize yourself with their rules. Only deal with those funds that allow a reasonable amount of switches. The same game with a slight twist. An additional choice was recently added to the switch fund game. When you buy a mutual fund, you're obviously getting a diversified portfolio of stocks in those sectors currently favored by the fund manager, autos, chemicals, technology, or what have you. But suppose your technical work shows that one particular group is ready to be a real standout. No problem. You can now buy mutual funds that invest strictly in one sector. Although investing in such a narrow fund is obviously more dangerous than going the traditional route of the more diversified fund, the potential rewards are far greater. Several mutual funds have now made these sector funds available. There's usually a low load put on these funds, but when used properly, that's no great deterrent to excellent results. While certainly not the only mutual fund to offer these sector funds, Fidelity Funds has, in my opinion, the best and most complete overall game plan in this area. First, there's a large choice of funds, 35 at last count, that allows you to be quite specific as to sector. In addition, while there's an initial 2% fee for entering the plan, and a 1% charge if you take the money out of the family of funds, it is a one-time charge. As long as you keep the money within their sector fund plan and move, for example, from gold to technology, or if you don't like the market at all and move into their select money market fund, you never have to pay the 2% charge again. All you're required to ante up is a $25 transaction fee when you liquidate the sector funds. On a large amount of money, this is minuscule. Also, they price their funds on an hourly basis. So if you see an important move starting early in the day, you don't have to wait for the closing price, which can be considerably higher, as you do with most other funds. This is another fine area for your IRAs or pension funds, as well as a portion of your trading funds, especially if you lack the time to check out individual stocks. If you zero in on a winning sector such as energy in 1986 to 87, your rewards can be fantastic. Fidelity Select Energy gave a strong buy signal at point A on chart 9-6 back in mid-1986, when it first moved above its 30-week MA. It broke out above resistance at $10.40 as it started a Stage 2 advance. It remained in a bullish Stage 2 uptrend for the next 14 months, finally giving a very timely sell signal in early October 1987, just before the crash. In addition to supplying you with a choice of 35 different market sectors to buy, Fidelity now also makes available 8, and in the future it's likely to increase, sector funds that you can sell short. Besides being a very profitable trading and investing game, following these 35 sectors also helps you to uncover those 1 or 2 areas where you should also do heavy individual stock buying. For both reasons, make sure you pay close attention to these funds. Options. A very exciting but risky game. The next investment vehicle to explore is that of options. If ever the phrase "not for widows and orphans" applied to an investment area, it would certainly apply to options. These instruments are strictly for professionals and high-risk players. Under the best of circumstances, options have a high degree of risk. Of course, the other side of the coin is that when you are right, the payoff can be fabulous. While I cannot teach you how to bring the risk level of options down to that of a utility stock, I have a few tips that will make them a bit less risky. And more importantly, these concepts will increase your winning percentage. Those of you who aren't familiar with them, here's a nutshell description of call and put options. Owning a call gives you the right to buy a stock at a given price, the striking price, for a specified time period, until the expiration date. The price you pay for an option is called a premium. When you buy a call, you are hoping that the underlying stock upon which the call is written will advance in a hurry, which is what makes this vehicle so tricky. Very often you can be right about the stock advancing, but if it doesn't happen before your call expires, you're out of luck. If you buy a call that expires in 90 days, a big jump on the 91st or 92nd day is of no benefit to you whatsoever. While you can buy calls with 3, 6, and 9-month expirations, the longer the time period that you contract for, the more expensive it is. In addition, the longer-term options lack the liquidity of short-term contracts. There's much more active trading in 3-month options because of the short-term orientation of most option players. When you buy a 3-month call on stock XYZ with a striking price of $25, its intrinsic value is $1 if the underlying common stock is trading at $26. The price of the common minus the striking price equals intrinsic value, i.e., 26 minus 25 equals 1. This isn't some fancy formula, it's market reality. If you want, you can sell the common at 26 and simultaneously exercise your option privilege to buy at 25. In the real world, the option will almost always sell at a price above the intrinsic value. In this case, if the common is at 26 while the striking price is 25, and the call sells at 1.875 rather than the intrinsic value of 1, the time value is 0.875 of point. The time value is that extra value above the intrinsic worth at which the market values the call. The same is true for puts. If the common advances to 35 in the weeks before the call expires, the price of the call will have to rise to near 10. If there's still plenty of time before expiration, it will probably sell at an even higher price. While the underlying common advanced a very healthy 40%, your option chalked up better than a 400% gain. It's this chance to grab the gold ring that keeps the option buyers coming back for more, even though most of them lose in the long run. A put is the opposite of a call. It's similar to selling short. If you expect the stock to get smashed, buying a put gives you the right to sell stock XYZ at a given price for a specified time. If the striking price for your put is 50, and the stock is currently selling at 49, then the intrinsic value is 1, since you can buy the stock for the current price of 49 and immediately exercise your put at 50. In the next few weeks, if XYZ declines to 40, the market value of the put will move to at least 10, which is the intrinsic value. The drop in the common stock represents a 20% decline, which certainly would be a fine short-term profit if you sold the stock short. But your put profit is in excess of 400% since it advanced from 1.875 to 10. The positives of buying calls and puts are obvious. If you are right, you can hit a grand slam home run. Another positive is that you can define your risk. A put represents an option on 100 shares of stock. If each put costs you $200 and you decide to buy 10 puts that sell at $2, you can lose no more than $2,000 on that particular transaction. The same mathematics applies to calls. The final plus is that for a small outlay of money you can get a big bang for your buck. Unfortunately, this coin has a flip side to it, the downside. If you buy the put for $2 with a 50 striking price, and at the time of expiration you are still holding it while the stock is at 51, it's worthless. You lose your total investment of $2,000. In the same manner, if you buy 10 calls with a 25 striking price for a total outlay of $2,000, and they expire with the common at 24, you are out the full amount of your investment. Since the striking price was 25, they have no value. Another risk is that if you pay too high a premium, you can be right about the stock's trend and still wind up losing money. The stock price may not change enough to make your position profitable. For example, you buy a put with a striking price of 50 when the common is at 50.50. The premium is $6. The stock has to drop to at least 44.50 before you break even on the put. Another danger is the very thin nature of this market. So be absolutely sure to use limit orders rather than market orders when buying puts and calls. If you don't, the market makers will have a field day with your executions, and you'll find it even more difficult to make money in this arena. Obviously, buying calls and puts isn't for everyone. If you are a long-term conservative investor, don't even think about it. There are hedging strategies that conservative investors can use that entail far less risk, but also less chance for profit. These strategies are for people who cannot decide if they're bullish or bearish. To me, they are half measures that lead to mediocre returns. I really don't agree with the concept of holding a stage 4 stock but selling a call against it to cut your loss. I am also negative on selling a call against a stage 2 stock to get a few more dollars while cutting the chances of a further large upside gain. To me, if you're bullish, you buy stocks and calls. If you're negative, you sell stocks short and buy puts. Even if you're a really aggressive market player, I disagree with the idea of making option trading your primary market activity. Balance is the key to success in the market as well as in life. If you feel comfortable with options, then allocate only a small percentage of your capital to this volatile area. Even a small position will give you more action than you'll see in a Vegas casino. The major difference between a casino and options trading using my rules is that my method puts the odds in your favor instead of with the house. Here are the proper ways to increase your probability of success. 1. Buy a call option only on a stock that is in stage 2 or is moving into stage 2, and only buy a put option on a stock that is in stage 4 or is first entering that negative phase. Look at this daily chart of IBM chart 97 in 1987. From the time IBM broke below point A, it was in poor technical shape and had close to a 0 chance of becoming a winner on the upside. Yet every day after it broke down at point A, large numbers of calls were purchased. It's therefore not surprising that the overwhelming majority of options expire worthless and most option speculators end up behind the 8 ball. 2. Buy only an option that has big potential. It's a fact of life that you are going to be wrong with more of your choices in the option sector than when buying stocks. That doesn't mean you won't make good money. In fact, if you strictly follow my methods, you may very well make a greater percentage return on your capital than in stocks themselves. But for this to occur, you have to promise yourself that you'll only buy a call or put on an A+ situation with tremendous potential. If you rigorously follow this discipline, you can be right much less than 50% of the time and still rack up a small fortune. This will happen only if your losses are kept small and your correct calls are home runs. Don't fall into the trap that so many option players do and bet every race because you need the action. Selectivity is absolutely crucial. Swing only at the best pitches. 3. Give yourself a reasonable amount of time before expiration. It's hard to be right in the options market. It's even tougher to be correct within a limited time span, and it's nearly impossible to be correct within only a few days. So give yourself a break and make sure you buy only options that have a reasonable amount of time left until expiration. Ideally, that's 3 months, but never less than 45 to 50 days. Option players too often choose an option that has a month or less left until expiration because it's cheap, i.e., small time value premium. Stop looking for bargains. Of course, the premium will be small on those options with very little time left. You never get something for nothing. An option is a wasting asset, and the closer it moves to expiration, the less it is worth. Thus, the cheaper price is not surprising. If you buy options that have an inadequate amount of time left until expiration, you won't like what your profit and loss sheet will look like down the road. 4. Buy an option that is close to the striking price and, if possible, in the money. This is a tricky area. On the one hand, we all want to put up as little cash as possible and, if we're wrong, lose only a small portion of it. That's why so many option players buy options that are way out of the money, which means that the current intrinsic value is negative. If you buy a call with a $50 striking price, but the common is currently $45, your call has no real value. It's out of the money by $5. If it was to expire with the common still down at 45, you'll lose whatever you paid for the call. Yet many speculators buy these far out of the money calls and puts because they can purchase them very cheaply, and every once in a while one of them pays off big. In the above case, if the common takes off and runs up to 55 before expiration, a 50-cent call will increase 1,000% to at least 5. So an investment of only $10,000 would be a fast $100,000. These success stories do occur, and that's the lure. But it certainly isn't a good probability, any more than gambling on 00 in a Vegas casino. I don't want you going for the long shot, but rather for the consistent good play. On the flip side of the coin are those who play it too safe by buying an option too far in the money. If the stock is currently at 50 and you buy a call with a 40 striking price for $10, you have to lay out a lot of money, and you lose a good deal of upside leverage. In addition, the reward and risk factor isn't great. If the stock runs from 50 to 60, the call must mathematically increase from $10 to $20. But if the underlying common heads south and you hold it while it drops below 40 by expiration, you'll lose the full $10 per call. In this example, you'd have a 1-to-1 reward and risk ratio, which is not acceptable. So what's the answer? The ideal compromise is to buy a call or put that is slightly in the money. For instance, if the common is trading at 50.50, then a call with a $50 striking price makes sense as long as the premium isn't ridiculous. If it is, you must pass on it or wait for the enthusiasm to die down and the price of the call to dip. If you pay $2 for this call and the stock runs up to 60, you'll make 400% on your money because the option will move up to at least $10. If it expires worthless, you'll lose $2. That 4-to-1 reward and risk ratio is more exciting than the previous 1-to-1 example. Don't make the game even tougher than it has to be. All things being equal, buy an option that's slightly in the money. Or if it's out of the money, make sure it's very close to the striking price. In addition, remember it should have 2 to 3 months left before expiration. 5. Use a very tight protective stop on your option positions. When buying a call, don't set your sell stop the way you would an investment stop. Use the rules I showed you for adjusting trading stops and, when possible, be even more aggressive. Don't set your stop on the actual option. They trade too thinly. Instead, use a mental stop watched by but not physically placed with your broker on the underlying common stock. If the common moves against you, instruct your broker to immediately sell your call or put. This daily chart of digital equipment, Chart 9.8, fondly known as DEC on the street, illustrates how aggressive to be. Because an options expiration meter is always running, any sign of weakness is a reason to say goodbye to the position, thus locking in your profit or limiting your loss. If you play your hand properly, you should rarely lose all the money you invest in an option. This is another error the average speculator makes. Assume that he buys a call for $3 and the underlying common fouls up. If there is still plenty of time left on the option, the price might still be $2. But instead of cutting the loss and looking for a new play, our hapless trader figures that 60 to 90 days will be sufficient time for things to work out. When it doesn't, he ends up with nothing. You should exit as soon as the common stock starts to show signs of even short-term weakness. In the case of DEC, the stock should have been bought when it broke out above the downtrend line at point A. A close stop should have been set at B and quickly raised to C, D, E, and so forth. In the following weeks, the stock broke below point F at 160. If you had bought the April 105 call when the common was moving above 108, you would have paid around 9. When your mental stop was hit in March, it was time to exit the position with an excellent profit as the 105 calls were now worth $55. A second good upside trading opportunity was provided in early August when DEC once again broke above an important trend line as it moved above 169.G. You could have bought an October 165 call for 9. Then, when the uptrend line was violated for the common in early October at 190, you should have exited your call position with another fine gain, as the call was around 26. If you didn't sell, however, the position was soon worthless. Some real-life examples. To see how profitable these speculative vehicles can be, let's follow the progress of a few option recommendations that I made in PTR. In early January 1987, I advised subscribers to buy calls on Texas Instruments, chart 9.9. The common moved above major resistance at 125. When TXN did move above 125.50, you could have bought an April 125 call for about $7. In early April, when TXN reached its high of 203.B, the call option's intrinsic value was $78. Here's where the exciting power of leverage makes itself felt. While the common chalked up a very respectable 60% plus gain, the call option charged ahead over 1,000%. The same mathematics show up when buying puts. In October 1987, I recommended buying puts on Xerox chart 910 when the common completed its major top at point A. You could have bought a January 75 put for about 4.50. The stock dropped very sharply in the next few sessions to 50. That was a fast 30% gain on the short side. But the action of the January 75 put was even more impressive as it skyrocketed from 4.50 to 27.50 for a fast 500% plus increase. Obviously, if you're an aggressive trader and love high-risk vehicles, this is an area where you should do some selective trading. Under no conditions, however, should even the most aggressive speculator put all of his market capital in options. Options trading is very seductive. A few lucky situations can turn traders into option junkies. Don't let it happen to you. And remember that it's imperative for you to follow the rules I've taught you in this chapter if you want to survive and prosper in this speculative jungle. It's no different when dealing with the futures. You now possess the ability to spot the start of new trends as they unfold. It's no different than developing any other talent. The more you work at it, the more proficient you'll become. Be aware that the profitability of chart reading isn't limited to stocks. I've already shown you that it's great for mutual funds as well as options. The final area where you can put it to use is with futures contracts. With a slight alteration in the method, you need a shorter time frame and moving average. You can do amazingly well with any of the futures contracts, be it orange juice or stock index futures. If you're going to compete in this area, I suggest that you subscribe to one of the futures chart services. Look at chart 911 of Orange Juice Futures and note that in the June to August 1987 period, the January 1988 contract formed a small reverse head and shoulder bottom. The same formations will occur on futures charts as on stock charts, but with futures the process is far more rapid. It's like playing a record that was recorded at 33.33 RPM at 78 RPM. You have to be much more sensitive and develop a short-term feel if you're going to stick your toe into the futures pit. This is not an area where you can check your prices only on the weekend. Daily contact is vital. If you purchased orange juice contracts when the futures moved above the neckline point A, you would have done very well. If you had wanted to play it on a trading basis, after initially setting the stop right under the reverse right shoulder, you should have pulled it up to points B, C, D, and E. You then would have been stopped out for an excellent profit when this contract broke below the stop at point E. If you want to play investor, then you could stay with the contract as long as it remained above the 40-day MA dotted line on chart 912. The amazing thing is that you can know absolutely nothing about the fundamentals of orange juice, copper, soybeans, or other commodities. Yet you can turn out to be far more accurate in your predictions than someone who spends their time reading all the fancy reports put out by the Department of Agriculture. Another high-risk but exciting vehicle is the stock index futures contract. There are now several different such contracts trading, each based on a basket of stocks. The best known and most heavily traded futures contract is the Standard & Poor's S&P 500, which the institutions love to play. Not quite as active is the Value Line futures contract, which, unlike the S&P contract, is weighted towards secondary stocks rather than blue chips. Many market players and analysts alike were caught in the historic October 1987 crash that they said came out of the blue, but a look at chart 913 shows that this absolutely was not the case. Between June and early October, a clear head and shoulder top pattern formed. Once the neckline was violated, it was truly a case of bombs away. This is even more obvious when you look at chart 914, which is the S&P futures contract charted on a weekly basis. So if you did your technical homework, there was absolutely no excuse for getting trapped on the long side in that horrible debacle. I cannot overstress the point that this sector is a high-risk game for professionals and sophisticated traders. The flip side to the high risk is that the payoff can be incredibly big. One contract shorted when the neckline was broken. At that time, a margin down payment of $7,500 per contract was required, would have yielded a profit of over $66,000 a few days later at the crash low. The lesson is clear. From now on, when trying to predict future prices, whether it be for IBM, a mutual fund, a stock option, gold, or soybeans, forget about reading the financial pages. Instead, grab hold of the chart and study it carefully. Chapter 10. Putting it all together. In working through the past 9 chapters, you should have discovered the truth of that Chinese philosopher's famous statement, "A journey of 1,000 miles begins with a single step." When you first started reading Chapter 2, my ideal stage chart, 10-1, probably looked like a Rorschach test. But if you've done your technical homework, brick by brick has been put into place, and the language of technical analysis is now very understandable to you. In addition, some statements that I made earlier in the book probably sounded like heresy, such as buy high but sell higher, but now should be seen in a much different light. Promise yourself that you absolutely will never again buy a stock in stage 4 no matter how exciting the story. Also swear that you'll never hold onto a declining stage 4 stock no matter what rumors come your way. Also vow that you won't have a change of heart when you see the next exciting earnings report. Your buy and sell decisions are going to be timed from the chart pattern, not from press releases. No longer will you be amazed at seeing Sears rising in 1985 on decreasing earnings and then crashing in 1987 on increasing earnings, chart 10-2. You now have a game plan. Don't underestimate its importance. If you follow my tactics in a disciplined manner, you'll never again be behind the 8 ball as are so many investors and traders. There will be occasional whipsaws, but you won't ever have to worry that any one position will reverse and wipe out your market capital. By using diversification, both in the number of stocks and market sectors, as well as intelligently placed protective sell stops, you'll be assured that your negative positions will be more an annoyance than a financial danger. More important, your winners will be home runs rather than singles and give you a very satisfying bottom line result. Finally, you'll never suffer the confusion on the upside that most market players do. Even when they turn out to be right, they're filled with anxiety and usually end up selling far too soon, thus missing the lion's share of the gain. And in those cases where they do hang on, they often overstay the move and give most or all of the profit back as the stock plunges into stage 4. This shouldn't ever be your fate. From now on, whether you're an investor or a trader, vow to be consistent to your system. Do not make any exceptions. Never believe that this time it's different. Always follow these steps. 1. Check the market indicators for overall direction. 2. Scan the groups so you'll know which ones to zero in on. 3. Cull out those few stocks with the most potentially profitable formation within those favorable groups. Once you've taken these steps, here are some rules to follow if you're an investor. Do most of your buying early in stage 2 when major bases are being completed. If you're a trader, concentrate the majority of your buying in continuation type buy patterns that are already in stage 2. Before entering your buy order, make sure you know where your protective sell stop will be set. If it's too far away from the purchase price, look for a new buy or wait to purchase the stock when a safer stop level forms. The converse is true when selling short. Never sell a stock that's in stages 1 or 2, especially stage 2. Never buy a stock that's in stage 3 or 4, especially stage 4. Never hold a long or short without a protective stop. Don't be afraid to sell short when the overall trend is bearish. Just be sure to protect the position with a buy stop. Be aware that stage analysis can be applied to any and all investments that are governed by supply and demand, which includes stocks, mutual funds, options, futures, and commodities. Never guess a bottom. Learn the important lesson that it's better to be late and buy in stage 2 than to grab a stock that looks cheap but will be 40 to 50% cheaper later in stage 4. Don't feel you have to be 100% invested at all times. Differentiate between a September 1982 situation, when the indicators and charts strongly suggested a fully invested position, versus a September 1987 position when extreme caution was demanded. Buy stage 2 strength. Sell stage 4 weakness. In other words, always be in harmony with the tape. Whenever there's a conflict between the price-volume action and the earnings, always go with the objective message being supplied by the technical approach. While I cannot guarantee that you'll make millions in the market, I can assure you that no single commitment will ever wipe you out. You'll never have your capital locked into disastrous positions that prohibit you from reversing and getting aboard a profitable new trend. You'll always make decisions in a rational manner, which will lead to peace of mind and definitely improve your batting average. You'll always be able to objectively judge where and when a given stock should be bought and sold. All of these important pluses should dramatically improve your market results. A few last suggestions. Many market books recommend that you first play on paper before risking your capital in the market. I disagree. Many athletes perform incredibly well in warm-ups, only to choke once the actual game begins. It's no different in the market. When there's no pressure on you, it's very easy to cite the proper chapter and verse. Dealing with the real-life stresses caused by the market's zigs and zags while sticking to your game plan is another case. Therefore, instead of playing on paper, use only a portion of your capital until you sharpen your technical skills and reach a higher level of confidence and proficiency. A tactic that I used when I first started playing the market was to keep a diary. I strongly suggest you do likewise. In this diary, enter only your losing trades. Winners always take care of themselves. While it's nice to have both your pocketbook and ego enhanced, winning teaches you nothing. Losing can be the greatest teacher of all if properly analyzed. In the final analysis, losing can actually lead to far more winning trades. Write down the date that you bought your losing position and your reason for buying, and be honest with yourself as to why it didn't turn out. If it was merely a whipsaw, say so. But if upon later examination you realize that either the volume was inadequate, or the relative strength was lacking, or the group was negative, or you were influenced by a rumor, write down that error. After several months, look for a common denominator in your losses. We all have psychological patterns. When you see what your particular destructive pattern is, it will be easy for you to retrain yourself and deal with it so your investing will become even more profitable. I also want to stress that you most definitely should not be in awe of the big money institutions. Too many investors feel they cannot compete in today's marketplace with the so-called financial giants. This is nonsense. You actually have an advantage over the large institutions. Most investors just don't realize it. The institutions are like dinosaurs. They have big bodies and move very slowly. You, however, can turn on a dime and act very quickly. In addition, most of the hot-shot money managers really haven't performed that well over a long period of time. So take responsibility for your investments instead of being intellectually lazy and letting someone else manage or mismanage your money. One last fallacy to steer clear of is that you need megabucks to be successful in the market. While it's easier to diversify when you have significant market capital, even a few $1,000s will allow you to do very well in the market if you combine it with that rare commodity, common sense. If you have a very small starting nest egg, use no-load mutual funds. They will give you diversification and have no commission costs. As your market stake begins to grow, branch out and invest in individual stocks. In closing, I once again want to use contrary opinion. Don't think of this as an end, but as a new beginning. When I read my first book on technical analysis many years ago, Technical Analysis of Stock Trends by Edwards and Magee, it opened my eyes to an entirely new approach. Over the years, as I became more and more proficient in charting, I went back and periodically reread that book. Each new reading gave me greater insights because I was able to view it in terms of my increased market sophistication and experience. So go out and practice what I've taught you, and then return in 18 to 24 months and see if the concepts in this book don't mean even more to you the second time around. Until the next time we meet in these pages, just remember that the professional tape reader logo is true. The tape tells all.
Thank you for listening to this audiobook. We truly appreciate your time and support. If you enjoyed the content, don't forget to subscribe to the channel, like this video, and share it with others who may also benefit from it. Your support helps us bring more great audiobooks and learning resources to you.